Very good morning, good afternoon, good evening, based on whatever time you're watching this video. Friends, in this particular series, we'll be seeing GST amendments in a lot of parts as well as GST circular in a lot of parts. So, this would be relevant for your May 2025 exams. And this time, amendments are high compared to your November 24, where there are no amendments. So, it would be very, very important for your exams. Specifically, the first part where you're talking about GST amendment series, where there'll be a lot of parts, small parts of videos, and followed by GST circulars, and that will be again small parts. Make sure that you go through all the videos of GST amendments as well as your circulars, because amendments would always carry a good amount of marks. So you don't miss out on the amendments, and it will be very important when you are writing your exam. So make sure you don't miss any of the videos, revise them thoroughly. Other areas, yes, you have to focus, but amendments specifically, you have to be having all the amendments in your hands. So that is the importance of amendments. I hope you'll be enjoying all the amendments. You'll have a lot of clarity in all the amendments and the circulars. Thank you. Yes, friends. Now let us focus on the amendment which has come in your valuation, specifically in your rule 28. So the amendment has come in your valuation rule 28 sub rule 2. So when you talk about rule 28 sub rule 2, what is the amendment basically and what is the provision basically? Rule 28 basically talks about transaction between related person or distinct person. So basically if you see rule 28, it focuses on transaction between either related person or your distinct person, not being principal agent. But this rule has got two parts. Rule 28.1, the general part, rule 28.2, the specific part. The amendment has come in rule 28.2, which talks about a particular type of services that too between related person. So here the scope of distinct person is ruled out. It is only related person, that to particular transaction. Now what is the transaction? The transaction referred to is giving corporate guarantee on behalf of another person. Right. So supposing there's a bank or financial institution and there is company 2 which has taken the loan from bank or financial institution, and company 1 gives a guarantee to the bank or financial institution that the company 2 would be paying the loan properly. If not, they will take care of it. So loan is actually taken by company 2, but the corporate guarantee is given by company 1. Understand that any company or any person for that understanding, if he's giving guarantee for someone else to a bank or financial institution, he'll be charging something. But the tricky part here is, it is highly possible that this entire transaction is between related persons. So we are talking about a scenario where it is between related person. So this is the entire understanding. This is the scenario where your rule 28 sub rule 2 comes into picture. So who is giving what services? Who's the supplier? Supplier is company 1. Company 1 is the supplier and recipient is company 2. Why? On behalf of company 2, the supplier company 1 is giving guarantee to the bank or financial institution that the company 2 will be paying the loan properly. If not, they will take care of the loan. They'll repay the amount and they'll try to make sure that they recover the amount from company 2. So this is the entire understanding. Rule 28.2. Now, this rule was already in place and it gave a valuation as well. So assessable value in this scenario was 1% of the guarantee amount or actual consideration. If at all, though the company 1, supplier, and the company 2, recipient are related person, there might be some consideration which is charged for giving this corporate guarantee, which is in normal course. It might be there, whichever is higher. If the guarantee amount is 1 crore, 1% of 1 crore, or actual consideration, whichever is higher. Now, this was already in place. This was entirely thing is given in rule 28 sub rule 2. Now, what are the amendments? Now, what they have brought in picture is, they have said first thing that this recipient should be located in India. So first point is, they have very categorically said that recipient should be in India. Supplier can be in India or outside India, but the recipient, the related person which is the recipient, should be in India. The related person, which is the recipient, should be in your India. That's the first amendment. Second amendment, they have said that this 1% of guarantee amount is not every time, it is per annum. It is per annum. Right, so 1% is for particular financial year, per annum. If at all the guarantee is given for the 6 months of that particular thing, means it is renewed every year, so it will be proportionally calculated. So it's per annum. The third amendment which is coming out is, if the recipient is eligible for full ITC, just like Rule 28.1, they brought this concept of deemed open market value in Rule 28.2 also. If the recipient is eligible for full ITC, any value which is declared on the invoice shall be treated as deemed open market value. It shall be treated as the accepted value. Any value, whatever value you give, even if it is 0, it is fine. If the recipient is eligible to take full ITC, forget about it. Any value that you declare is the value as per Rule 28.2. So that is a clause. If at all recipient is eligible for full ITC, you need not break your heads for 1% of guarantee amount per annum or actual consideration which is higher. You can straight away take any value because recipient is eligible for full ITC. Any value includes even 0. So these basically are the 3 amendments that have come. What is point number 1? Point number 1 is, they have categorically said that this is applicable only and only if the recipient is located in India. Supplier can be outside India or in India, but recipient should be in India. Second, they have categorically again said that this 1% figure of corporate guarantee is per annum. And third, they have again simplified the provision by telling that, just like 28.1, if at all the recipient is eligible for full ITC, if the recipient can take full ITC, don't enter into the complication of this rule. Any value can be taken as any value that they agree. Assume that the corporate guarantee is 1 crore. So 1% of 1 crore and the actual consideration is say 70,000 or 70,000. Forget about the entire complication. Forget about it. You can put any value. You can put any value for that matter if recipient is eligible for full ITC, because anyways, whatever output tax the supplier related person pays, the recipient related person can take the input tax credit. So that is the logic. The same logic of Rule 28.1 is brought in Rule 28.2. So these 3 are the amendments in your Rule 28 sub Rule 2, which is with effect from 10th of July 2024. Amendment with respect to your Rule 28 sub Rule 2. Now, with regarding to the first point, please understand that if at all supplier is in India, recipient is in India, Rule 28 sub Rule 2 is applicable. Supplier is outside India and recipient is in India, even then Rule 28.2 is applicable. If supplier is in India and recipient is outside India, what is the application? This we are talking about corporate guarantee services between a related person. So in the first case, you can go with your Rule 28 sub Rule 2. It is applicable. In the second case also, you can go with Rule 28 sub Rule 2 because recipient is in India. Supplier can be anywhere. This basically is nothing but your importation of services. In the third case, you cannot go with Rule 28 sub Rule 2. It is basically technically nothing but supplier is in India, recipient outside India. It is export of services. When I tell you cannot go with Rule 28 sub Rule 2, it means that you are not covered by Rules 28 sub Rule 2. You are covered by the general rule. What is the general rule? You have to go by virtue of Rule 28 sub Rule 1. Rule 28 sub Rule 1. So this you need to understand that, okay, this is the provision where they are talking about generally both are, if at all both are in India, not a worry. Rule 28 sub Rule 2 is applicable. We are talking about corporate guarantee services between related person. Supplier is outside India, recipient is India. It's nothing but import of services. Again, Rule 28.2 is applicable. All the 3, entire points including the 3 amendments are applicable. But if it is ulta, supplier is in India and recipient is outside India, when you look at the amendment, you'll understand that now they have categorically said that recipient should be in India. But here, this condition is not being satisfied. So rule 28 sub rule 2 will not be applicable. You have to go with the basic rule, rule 28 sub rule 1. This is basically nothing but export of services. So go with the basic rule 28.1. This is everything about the amendment which has happened in your rule 28 sub rule 2. Yes friends, now discussing about the amendments in your RCM specifically. Now there are basically two items that attracts important attention. One is RCM with respect to notified goods in section 9.3 read along with notification 4/2017 CT rate, and another is your RCM on services section 9.3 read along with notification 13/2017 CT rate. So basically there are two new entries in RCM, one for notified goods and one for notified services, both under section 9.3. Now the one which is for goods is talking about metal scrap. Now what it is telling, any metal scrap which is falling under chapter 72 to chapter 81. So lengthy chapter list is there. So any of these 10 chapters 72 to 81, any metal scrap which is falling by these under these chapters 72 to 81 of first schedule of Customs Tariff Act, which is supplied by unregistered person to registered person, the registered person has to pay under RCM. So any metal scrap for that matter, which is covered from chapter 72 to 81. This chapter basically is taken from your Customs Tariff Act, because more or less classification in GST and customs are the same. So chapter 72 to 81 of Customs Tariff Act 1975. If it is supplied by a person who is unregistered and to a person who is registered, it will be covered by RCM. What is the implication of it? Unregistered to registered is RCM, registered to registered is FCM. If the supplier is unregistered, recipient is registered, then RCM. If the supplier is registered, recipient is also registered, then is FCM. So basically you can have various permutation combinations. Supplier unregistered, recipient registered, or supplier is registered, recipient is unregistered, or supplier is registered, recipient is also registered, or both supplier is unregistered, recipient is also unregistered. On the left hand side we have understood that we are talking about the supplier, on the right hand side it is the recipient. So unregistered to registered, then this attracts RCM, recipient has to pay RCM. If it is registered to unregistered, it is FCM, supplier has to pay tax. If it is registered to registered also, then it is FCM, supplier has to pay tax. Even if it is unregistered to unregistered, supplier is also unregistered, recipient is also unregistered, it is FCM. The only point that you have to understand is whether this person is going to pay tax or not is a question. So he may be not registered because of his threshold limit. So here either there will be no GST, if at all he is not at all liable for registration, or if at all there is GST, it will be under FCM. So out of all these four cases, only the first case where the supplier is unregistered, recipient is registered, only and only in that particular scenario the recipient has to pay tax under RCM. So I have written here recipient. So that is for metal scrap covered by chapter 72 to 81 of Customs Tariff Act. The next entry is going to impact a lot of businessmen, rather almost all the businessmen, where we are talking about entry number 5A. The above entry was entry number 8 in notification 4/2017. Now we are talking about entry number 5A in your notification 13/2017 CT rate. Now what it is trying to tell? It is telling that supply by way of renting of any property other than residential dwelling, which means they are talking about renting of commercial property. Renting of commercial property by unregistered person to registered person. Again, more or less looks the same, but then the same logic holds good when it is RCM and when it is FCM. So it is trying to talk about RCM, FCM, the understanding that we took in 4 examples, whole goods here also, same chart that we have taken there, it is equally applicable here also, same thing, because condition is same, unregistered to registered. But what is the bigger implication? They are talking about renting of residential, renting of a property other than residential dwelling. So renting of any property other than residential dwelling. So renting of a commercial property is taxable under RCM. Now understand that both these amendments are applicable with effect from 10th of October 2020. 2024. The impact of the second one. For both these amendments, whether it is your metal scrap or whether it is renting of commercial property, because property other than residential living, when it is RCM is clear, it will be only in the first case that it is RCM. Both these points holds good. But what is the impact now? What is the bigger impact now? Now you cannot think of a businessman where he's not having any property or rent. Generally, whether it is a big business or small business, one common expenses that you see in every business is rental expenses. Alright, so now what is going to happen is, when you talk about this rental expenses, the impact is big, very big. In this particular point, what it will happen is, they have to pay RCM. So supposing you are talking about renting of commercial property, a property other than residential dwelling, I'm calling it as commercial property, by unregistered person to a registered person, renting of commercial property. Though the technical wordings is property other than residential dwelling, it is nothing but renting of commercial property. This surely will attract RCM. Normally when we talk RCM, we always go by this logic: pay by one hand cash ledger and get the same in other hand credit ledger. So you'll pay by cash and get in credit. But the impact is much bigger if at all this registered person happens to be under composition scheme or happens to be in regular scheme where ITC is not applicable, not available to him. So he may be in restaurant sector where ITC is not available. Now the last category is regular scheme general. Now what will happen is, in the first two cases, there's a very big impact. Why? They have to pay under RCM. They have to pay by cash. But they will not get the input tax credit in credit ledger. If at all you're working under composition scheme or any other regular scheme, but where the rate notification is telling that you cannot take ITC. Say for example, restaurant sector, the rate notification tells it is 5% without ITC. So you are under regular scheme, but the rate notification is telling that you have to pay this amount but no ITC. You cannot take credit. You have to pay by cash, but you will not get the credit. If at all you are under regular scheme, generally what will happen is, you will pay that amount by cash ledger and you will get that amount back in your credit ledger. Pay by cash ledger, electronic cash ledger, get back that amount in electronic credit ledger the same month. So what is the difficulty now here is, the difficulty is for the first two set of category where this amount, what they are going to pay is going to be cost. Because normally when you pay RCM, it is not your cost, you pay by one hand, get the credit in other hand. But for them, for these two examples that I have taken, composition scheme a dealer or a regular scheme dealer where the rate notification tells that you cannot take ITC, that RCM payment, not only this RCM payment, any RCM payment for that matter will be a cost. For the last category, it is not going to be a cost. Why? They will pay by one hand and get the credit in other hand. So they will pay by cash and get the amount in electronic credit ledger. Though this is common for any type of RCM, this particularly is not only for renting of commercial property. It is common fact. Common fact, if at all it is RCM and if you are under composition scheme or regular scheme where ITC is not available, the amount paid will be cost. And if at all you are talking about a situation where you are under regular scheme, so you will pay that amount, RCM amount, by cash ledger and get the amount in credit ledger. It is not a cost. So that is common for all. But what is the highlighting point is, renting of commercial property is a very common expenditure, a common item that every businessman will have, mainly the small business owner who will be going under composition scheme. So it will be a big headache for them. So these are the amendments when you're talking about RCM entries, one for goods category, another for your service category under section 9.3, and the logic is the same. One is goods category, metal scrap, chapter 72 to 81, customs tariff act, and other is renting of property other than residential dwelling. Common condition is supplier should be unregistered and the recipient should be registered. So both these notifications are effective from your 10th of October 2024. So now let us discuss about the amendments in your exemption notification 12/2017 CT rate along with the 9/2017 ID rate. The first one in the list is only importation of service related exemption. So therefore the notification you'll find is only 9 bar 2017 IT rate, integrated tax rate, because it is only dealing with interstate supply. All the other amendments are there both in 12 bar 2017 CT rate as well as 9 bar 2017 IT rate. So other amendments are there in both the notification, common for both. Now talking about the first amendment or first new entry which is there in your notification number 9 bar 2017 IT rate, which deals with importation of services, is the new entry 10L. It talks about a situation where there is importation of services by an establishment of a foreign company, not any foreign company, a foreign airline company. So import is by an establishment of a foreign airline company. Either it is from a related person or it is from an establishment that is its branch office outside India. So the condition number 1 is there is import of service, but from where? It is obviously from outside India. Who's the recipient? Foreign airline company. Who's the supplier? Either the related person outside India or the branch office or establishment outside India. Other condition is it should be without consideration. So if at all this is the situation, then it is exempted. So basically you're talking about a foreign airline company in India is the recipient. The supplier is its branch office, its related person outside India, or its establishment, that is branch office outside India. This is the supplier. Now when this service is being imported, now they've got importation of services, it is exempted if there is no consideration. If at all there is no consideration, then in such a condition GST will not be there. It is deemed supply, by the way. Even though there is no consideration, it would have been deemed supply, because you need to understand if there is no consideration, why it is exempted. Because it is covered by the aspect of deemed supply. Now though it is deemed supply, you're talking about para 2 of schedule 1, transaction between related person or distinct person. Though it is deemed supply, it is exempted. Technically, you can tell it otherwise. There is levy, but there is no collection. There is levy, but there is no collection of because of this new exemption notification. But you need to understand that there are other conditions as well. What are the other conditions? First, they clarify that what is meant by foreign company. Foreign company is the same meaning which is given to it in section 242 of Companies Act. What are the other conditions? The other conditions which are given here is it has to make sure this particular foreign company has to pay GST at applicable rates in India, both on its transportation of goods and transportation of passengers. So they are trying to tell that you pay GST on your actual supply of goods and actual supply of services, which is transportation of goods and services. If at all you're paying your taxes on your actual supplies properly, then this would be exempted. If this was not exempted, it would have been under RCM. Please understand. If by any chance it was not exempted, this transaction would have been under deemed supply and it would have been under RCM. Now that is exempted, this RCM is also not allowed. If at all it is exempted, no need to discuss FCM or RCM. It would have been under RCM. So first condition is, if you want to take the benefit of this exemption, the foreign airline company for its operation within India, transportation of goods and passengers, pay GST at correct rate. Second, Ministry of Civil Aviation should certify that this establishment of foreign company in India is an airline company which has been designated by the foreign government. So it should have been designated by the foreign government. Supposing this airline company belongs to USA, this airline company should have been designated by USA government under the bilateral Air Series agreement between the USA and India. So Ministry of Civil Aviation tells that, okay, we're going to give benefit to this foreign airline company if its government, that is the foreign government, has entered into an agreement, bilateral air services agreement with India. And additionally, Ministry of Civil Aviation further should certify that not only that it is this foreign airline company is designated by the foreign government, but also on reciprocal basis, Indian airline companies which are doing operations outside India such similar taxes are also exempted. So Indian airline company, when they are doing work there outside India, for their work they'll pay the GST or any taxes properly. But there might be some services which is provided from Indian branch office to the foreign Indian airline company branch office. So there, these similar taxes, whatever exemption is here given by India, should have been given by the other country. Same services appearing in the same entry, the government of the foreign country should also give exemption. Now, basically, what are we doing? This importation of service without consideration from a related person or a branch office outside India, when it is given to foreign airline company in India, we are exempting it. Similarly, the same kind of exemption treatment should be given by the foreign government if at all it is reverse scenario. So that is the requirement. So basically, they tell that we additionally require two conditions. Ministry of Civil Aviation, I'm putting under one condition, though there are 2 points, that we will be giving this exemption of import of service by a foreign airline company from a related person or a branch office or establishment outside India, if it is without consideration, no RCM, though there is levy deemed supply, but there is no collection, it is exempted because it is without consideration, no need of paying RCM. But condition number 1, that foreign airline company, when it is doing the business of transportation of goods and passengers, it has to pay GST at proper rates. Pay GST and take the benefit of exemption on this particular entry. Second, Ministry of Civil Aviation should certify 2 things. That this foreign airline company has been designated by the, properly designated by the foreign government, telling that under this bilateral air service agreement, we are having this authorization. There will be bilateral air service agreement between India and the other country. This airline company should be designated by that particular government, foreign government. Additionally, this exemption that we are giving to the foreign airline company in India, because we are having a bilateral air service agreement with the foreign government where the airline company belongs to, similar kind of exemption should exist in that country also when it's a reverse scenario. So that is given there. So this particular entry, new entry, is effective from 10th of October 2024. And this is discussed only in 9/2017 IT rate, as it deals only with interstate supply. Importation of services is always interstate supply. Now all the other entries that we are going to discuss basically are having impact both in intrastate supply 12/2017 CT rate and interstate supply 9/2017 IT rate. So they are actually covered by both, but why I put only one notification is the entry numbers will differ. So that is the logic. Now when you talk about government services, there are certain exemptions given for the services given by Ministry of Railways and at times to Ministry of Railways with effect from 15 July 2024. Right, so these exemptions basically deals only with Ministry of Railways. So we will be seeing another government services, but now I wanted to highlight focus only on Ministry of Railways exemption. Now services provided by Ministry of Railways to individuals should be to individuals, not a company, to individuals by way of giving platform tickets, facility in waiting rooms or retiring rooms, or cloakroom services to put your luggages, or battery operated cars for travel on the platforms, mainly used for people who are aged or who have disability or who have got huge luggages basically not at all, but still luggages will be carried on. So these services, who's giving? Ministry of Railways. To whom? Individuals. What all services? Other services. We are not talking about travel services, platform ticket services, or waiting room services, or you're talking about low room services for keeping the goods, or battery operated cars. That is one exemption. The other exemption is, this is in entry 9E. The other exemption is in entry 9F. Services provided by one zone or division under Ministry of Railways to another zone or division of Ministry of Railways. So one zone, northern zone of Ministry of Railways is giving services to southern zone of Ministry of Railways. So between these distinct persons, one zone or division of Ministry of Railways, that is Indian Railways, to another zone or division of Ministry of Railways, that is exempted. To take it out from the ambit of deemed supply. Otherwise, deemed supply would have hit para 2 schedule 1. Now, next is a special entry 9. E is there, F is there, G is there, 9G. Services by special purpose vehicles. Special purpose joint ventures or companies will be formed. Special purpose vehicles which are formed only to give certain services to Ministry of Railways. So what they will have the entire infrastructure built and owned by them. So we are talking about privatized railway stations, which slowly we are trying to see in India. Though it is in a very nascent stage, initial stage, privatized railway stations. On the trains, few trains are privatized, mainly the goods trains. I'm talking privatized railway stations. So what will happen? Supposing Adani is building a private railway station infrastructure, which is owned by Adani, and it is giving that infrastructure to Ministry of Railways. By allowing the Ministry of Railways to use that infrastructure which is built and owned by them during the concession period against a consideration. So there will be some point of time. It is just like your toll charges. Private companies will build the roads for some point of time, which is called as concession period. The private companies will collect the toll charges, so that government objective of good infrastructure is achieved. Private companies objective of doing some social service plus getting some cost back is also achieved, and even the citizens enjoy good infrastructure. The same way, there are pros and cons for sure, but the same way what is being done now, privatized railway stations will be done. They will be built, the entire infrastructure will be built and owned by private entities through special purpose vehicles, and then that special purpose vehicle will allow Ministry of Railways to use it, obviously against some consideration. That is exempted. That will be there till some concession period. After that, the entire thing will go under Ministry of Railways. Now when that is happening, Ministry of Railways will also give maintenance services to the special purpose vehicles. So first service was special purpose vehicles to Ministry of Railways. Next is Ministry of Railways. When they're taking that infrastructure and working on it, they might give certain services to special purpose vehicle, mainly maintenance services, in relation to the infrastructure built and owned by those special purpose vehicles in that concession period against a consideration. So basically understand, supposing a private railway station is built by Adani. Adani will give Indian Railways that infrastructure to be used by them for a consideration. That is exempted. And then Indian Railways will give Adani certain maintenance services because they are going to maintain. Indian Railways will take over the railway station under they in charge, and they will take care of the maintenance part. So Indian Railways giving services to Adani in terms of maintenance services against a consideration during that same concession period is exempted. So here it is two way. Adani to Indian Railways to Adani. What are the two different services? Adani to Indian Railways is service by way of allowing Indian Railways to use the infrastructure which is built and owned by Adani. And what is the service given by Indian Railways to Adani? During that period, the entire infrastructure will be under the control of Ministry of Railways. They will be maintaining that. Maintenance services given to Adani. So that will be that. Both are exempted. Both will be against consideration and both are exempted. So GST won't be there. Now, so that is the entry with respect to your government services effective from government services with respect to Indian Railways effective from 15 July 2024. The next entry where amendment is there. Now there's no new entry, there's an amendment in entry number 12. So renting of residential dwelling basically. Entry number 12, there's an amendment. Correspondingly, there's a new entry created, entry 12A. And both of them are effective with effect from 15th of July 2024. Now what is the impact of both these entries? Entry 12, there is an amendment. And entry 12A, there is a new entry which has been created. Now basically entry 12 was talking about what? Renting of residential dwelling for use as residence is exempted except when residential dwelling is given to a registered person. So if at all it is given to an unregistered person, it is exempted. Renting of residential dwelling to unregistered person is exempted. If it is given to a registered person, then it is not exempted. It is taxable under RCM. So that is this particular understanding. Now, there was an explanation one to clarify that if at all there is a proprietorship concern and proprietor has taken two residential properties on rent, one for his business, say for example staff quarters, and one for his own home. For staff quarters, it is not exempt because he will be acting as a registered person if he is registered. For his own residence, which is not a business expense but a personal expenses, that still will be exempted, because though that proprietorship concern may be registered, but when you're talking about his own house, then he should not be taken as a registered person. He should be taken as a normal proprietor, a normal individual who has got nothing to do with it. So that is a clarification which was already there. So we'll not spend time on it. I'm not trying to explain that area. It was already there. What is there in explanation 2? Explanation 2 tells that nothing contained in this entry shall be applicable to accommodation services for students in students' residences or accommodation services provided by hostels, camps, paying guest accommodation and the like. So this entry has put a full stop on a very long standing doubt telling that whether accommodation services given to students or accommodation services given by hostels, camps, paying guests can be called as renting of residential dwelling. Now they have said that it is not, this entry will not be applicable. It may or may not be covered by that, but it has categorically said that this entry is not applicable, right? Because this explanation 2 has been added because they have added entry 2A. What is entry 2A trying to talk about? Entry 2A is telling that accommodation services, whether it is for students or provided by hostels, camps or paying guests, etc., if at all the amount is less than or equal to 20,000 per person per month and the period of accommodation is minimum of 90 days, it is exempted. Amount is less than or equal to 20,000 per month per person, but period should be more, 90 days or more, then it is exempted. So this explanation is added for this particular point. Now both are connected. First, they have tried to say that accommodation services for students or given by hostels, camps or paying guest is not covered by this entry number 12. Entry 12 tells us accommodation service, we are covering it. It is exempted with two conditions. The amount should be up to 20,000 per month per person. Second, the stay period should be minimum 90 days or more. If both these conditions are satisfied, then it is exempted. Now, just to have a broader understanding, renting of immovable property. Renting of immovable property. Renting of immovable property. That immovable property can be residential property and can be, you can talk about a situation where you are talking about commercial property. If it is renting of residential property, then if at all you're talking, you have to categorize as both normal category, accommodation category. Normal category accommodation is covered by entry 2A. In normal category, what you have to understand is renting of residential dwelling or residential property for use as residence. For use as residence. For use as residence and given to unregistered person. For use as residence and given to unregistered person is exempted. This won't attract GST. But if at all it is not used for residence. It is renting of residential property, but if it is not used for the purpose of residence, or it is used for the purpose of residence but by registered person, if it is not at all used for the purpose of residence, then it is GST will be there under FCM. If it is used for residential purposes but it is by registered person, then GST will be there under RCM. Now when you talk about renting of residential property where you are talking about accommodation services, if at all it is accommodation services, there are two criteria. The amount should be less than 20,000 per month per person, plus the period of stay should be more than or equal to 90 days. If both of them are satisfied, it is exempted. In other cases means any of these two conditions are not satisfied, there will be GST, and that particular GST will be under FCM. No RCM, will be under FCM. Now when you talk about renting of your commercial property, the point is very pretty clear. If it is by unregistered person to registered person, first of all, it's always taxable. If it is by unregistered person to registered person, there is GST under RCM. In any other case, any other permutation combinations, GST will be there under FCM. Right. So here this is the entire understanding of renting of immovable property being a residential property and being a commercial property. This covers a lot about your exemption and FCM and RCM with respect to renting of residential dwelling and other than residential dwelling. Technically, it is never called as renting of residential property, renting of immovable property, which is a residential dwelling, and this is not a residential dwelling. So they use this particular language. So this notification 12 and 12A is effective from 15th of July 2024. Now, there's a new entry which has been introduced in entry 25A, which is effective from 10th of October 2024. A very simple entry. Earlier there was a circular telling that it is taxable. Now that circular is no more of any use because it has said that any other incidental services given by your electricity department is exempted. Service by way of providing metering equipment on rent. So supposing you have taken an electricity connection for your property, be it residential or commercial, but you want a new meter to be there. So whenever they give you a meter, they will be taking metering equipment on rent or testing the meters. If you doubt the meters, you can go for testing the meters or transformers, or shifting the line from one place to another place, or giving duplicate bills, etc. There are a lot of such services which EB department may give you, which are incidental or ancillary to the supply of transmission or distribution of electricity, provided by whom? Electricity transmission or distribution utility to their consumers. So when you are talking about services given by electricity transmission and distribution utilities to their consumers, main services electricity, supply that of electricity, EB charges. There are some incidental or ancillary services, be it renting of metering equipment or duplicate invoices charges, or shifting the lines charges, or testing the meters charges, testing the transformers charges, etc. These are all now exempted with effect from 10th of October 2024. So that is a new entry which has come here. Now, the other new entries which have come in your government sector, again, we already discussed your government sector, but in that particular government sector, we discussed only about Ministry of Railways. Now we are talking about other entries. Entry 44A, a new entry, research and development services, and entry 66A, which has got some connection with education. Now, entry 44A tells that research and development services against a consideration in form of grants supplied by a government entity or research association or university or college or other institution which is notified under section 35(1)(2) and 35(1)(3) of your Income Tax Act. So when you're giving research and development services where the consideration is received in form of grants, you're getting the consideration in form of grants. That R&D services should be supplied by whom? Either by a government entity. So that R&D services is given by a government entity or a research association or a university or a college or any other institution which is notified under section 35(1)(2) or 35(1)(3) of Income Tax Act, provided these research association, universities or college are notified at the time of supply. So they should be that notification should be effective when there is time of supply. So this is only a clarification. When they should be notified. We are talking about second category. Either R&D services supplied by government entities, one point. Second point is research association, universities, college, etc., which are notified under section 35. So when they should be notified? At the time of supply, they should be notified. Not every day. Supposing a new research association is notified today and the time of supply was earlier, then it is taxable because notification has come only as on date. Now there's another entry 66A, which talks about service of affiliation services provided by Central or State Educational Board or Council. So whenever you're talking about your school, they are always affiliated to so and so, correct? So you're talking about affiliation services given by whom? Central, State or Education Board or Council to a school, not any school, which is established, owned or controlled by government, central government, state government, union territory, local authority or government authority or government entity. So understand that service provider is whom? Central or State Educational Board or Council. That is the service provider. Central or State Education Board or Council. That is the service provider. Who is the service recipient? Service recipient is school, not any school. It should be government controlled school. The school can be controlled by central government, state government, local authority, union territory, or government authority or government entity. What is the service? Affiliation services. So supplier is Central and State Education Board and Council. Recipient is government controlled schools. Services affiliation service, that is exempted. Please understand that you are not talking about any school. If the school is not controlled by government, then it is taxable. If the school is controlled by government, then it is exempt. That is that. And the last in the list of your exemption notification amendment is educational services. Basically, one entry is substituted. Entry 69 is substituted, replaced. Right? It talks about vocational education, skill development courses. Skill development courses exemption notification was there. Now, the scope of skill development courses. So, when you talk about exemption, previously was given to skill development courses. Now also it is there. But the scope of the same is now widened compared to the old exemption given to skill development courses with effect from 10th of October 2024. So that this entry number 69, this entry was already there. It is now substituted by a new entry where exemption is now more, scope is widened. Right. So services given by National Skill Development Corporation, which was already there. National Council for Vocational Training. Now the name is changed. National Council for Vocational Education and Training. Awarding body was not there. Now awarding body is also exempted under National Council for Vocational Education and Training. So earlier it was NCVT. Now it is NCVET. National Council for Vocational Education and Training. Assessment Agency was already there. Now it is also there. National Council for Vocational Education Training. Training body was already there. Now it is also there. Awarding training body, which is accredited with an awarding body recognized by National Council for Vocational Education Training. Basically, if at all I want to tell, you will find this awarding body a new point. Otherwise, National Skill Development Corporation was there, National Council for Vocational Training was there. Now it is called as Vocational Education and Training everywhere. And secondly, awarding body concept was not there, now that is there. In relation to what? National Skill Development Program or any other scheme under National Skill Development Corporation. This was already there, no change. Vocational Skill Development Course under National Skill Certification and Monetary Reward Scheme. Now, Vocational Skill Development Course was already there. So, first 2 points are already there. Now, the last point is an extended version. National Skill Qualification Framework, aligned qualification of skill in respect to National Skill Council for Vocational Education Training has approved. So, here you will find a bit change rather than any other scheme. Here also it is any other scheme, but they have been very specific with what? It should be national skill, any national skill qualification framework, any national skill qualification framework for giving a qualification of skill in respect of which the National Council for Vocational Education and Training has approved the qualification package. So that's a small change. Rather, whatever I have circled in blue is the changes. The name of National Council for Vocational Training is now changed to National Council for Vocational Education and Training everywhere. The concept of awarding body was not there. Assessment agency, training partners was there. Now awarding body is there, and training partner should be accredited with awarding body. So that is a new concept which is more or less the same only. Right. Then in relation to what? In relation to types of courses. First 2 points are already there. The third point, any other scheme. Here earlier it was any other scheme implemented by National Skill Development Corporation. Now they are telling that any national skill qualification framework which is giving a qualification of skill in respect of which National Council for Vocational Education and Training has approved the qualification package. So that is a small change. In simple language, we have already discussed what this amendment has done. It has widened the scope of exemption given to skill development courses, which was already there in entry number 16. Now it is also there, but it is a bit widened. The scope is bit widened. Now, entry number 71 is a time pass because they have only changed the name, so I'm not going to take it. National Council for Vocational Training, wherever the term was there, it has changed to National Council for Vocational Education and Training. The same goes with the definition of approved vocational education course. Wherever you find the term National Council for Vocational Training, they have changed it to National Council for Vocational Education and Training. So this entry 71, you can ignore it. They have just changed the name, National Council for Vocational Training. Now it is renamed to National Council for Vocational Education and Training, and that is the reason you see the amendments here. So these are all the amendments with respect to your exemption notification. 9/2017 IT rate dealing with import of services, and all the other notifications were as per your 12/2017 CT rate. The same kind of the notifications also there in 9/2017 IT rate, but the entry number may vary. Yes friends, now let us discuss about your amendments in input tax credit. Basically, not much amendments are there in your input tax credit, and not so important amendments are also there. Very basic points are there. One amendment is there in your section 16 of CGST Act, which talks about eligibility and conditions for taking ITC. So there is an amendment in section 16 subsection 6, which talks about a situation where a registration of a person has been cancelled under section 29 and the same has been revoked. There is a revocation of cancellation either under section 30, or the cancellation is not revoked under section 30, but the cancellation is revoked by appellate authority or appellate tribunal or court, which means you are becoming alive again. So your registration was cancelled, that is you're dead, and again your registration is alive, that is revocation of cancellation is that either by the process under section 30 or by appeals, that is appellate authority, appellate tribunal or court. Now in such a case, you need to understand that there was quite an amount of period where the registration was not at all there. So it is highly possible that during that point of time, the person would have still carried on the business, and the credit would have yet to be taken. So either it might be old credit or the recent credit, but you need to discuss about the time limit for taking the credit. In such a situation where you're talking about the time limit for availment of credit. So what is the time limit for availment of credit in such a case? So they have categorically said that the time limit for availment of credit in such a cases where you are satisfying all the other conditions of your section 16 and section 17, which means the credit is not restricted under section 16 subsection 4, and you're also entitled to take input tax credit, which means it is also not restricted under section 17(5). The last date for which you can take the credit. Normally, what is the time limit for you to take the credit? So that time limit is already there. So you're talking about a situation where it is 30th November following the end of the financial year, which means 30th November of next financial year. The last return in which you can take the credit is October return of next financial year, filed before 30th of November of next financial year, or filing of annual return of that financial year, whichever is earlier. So that is already there. So this is the original time limit which is already there in the provision section 16. Now, along with that time limit, they have added one more point. So you're talking about a situation where the moment your registration is revoked from that particular time limit within 30 days. So you're filing a return within 30 days from the date of revocation of cancellation. So the moment your registration is revoked, you're going to file your return. And when you're going to file the return, it will be for which period? The period would be from the date of cancellation of registration or effective date of cancellation of registration, which means from the time limit your registration is cancelled prospectively, or effective date of cancellation, which is retrospectively. You're going to file the return for that period till the date of order of revocation. So technically it will be first return. You're going to file a return for many months. So it is only one return, but you're going to file it for many months. And that return is to be filed within 30 days of cancellation, revocation of cancellation order. So within 30 days from the order of revocation of cancellation, you have to file and compare both the time limits, whichever is later. So please understand for which period you are going to file the return. You are going to file the return from the date of cancellation, that is the order of cancellation or effective date of order of cancellation if it is retrospective, till the date of revocation. So this is the time period for which you are going to file the return. This is a period for which you are going to file the return. This period will contain many months, multiple months. Normally, what is the time limit for you to take the credit? Normal time limit would have been your 30th of November of next financial year, or actual date of annual return of current that financial year, whichever is earlier. Now, along with that, for this period, you will add what? 30 days from the date of revocation of cancellation. A return which is to be filed within 30 days from the date of revocation of cancellation. This time limit and this time limit, whichever is later. So it is highly possible that the earlier time limit is already over, because the revocation may be a very long gap if at all you're going for appeals. So this is the normal time limit that we always have. 30th November of next financial year, or actual date of annual return of that financial year, whichever is earlier. And when I tell 30th November of next financial year, it is not November return of next financial year, it is maximum. The latest return in which you can take the credit is October return of next financial year, to be filed on or before this date. Right. Now, the new entrant is in such a case where you're going to file a return for multiple months from the date of cancellation or effective date of cancellation till the date of revocation. You're going to file the return for the multiple months within 30 days of revocation of cancellation. Here it is whichever is later. So that is this amendment, and this amendment is here a clarification because you might have missed that earlier time, and this is effective from your 27th of September 2024. Now, the other amendment which has come out, which is basically there in your Rule 36, it is not Section 36, it is there in your Rule 36. So this amendment, which is there in your Rule 36, it's merely clarification, where you have one of the conditions for taking the credit, that it should not be a case of fraud. So how this condition is already there. There's just a small clarification. You cannot take input tax credit if at all you're talking about a person that a tax has been paid because of an order which is passed against the supplier, which is on account of fraud or willful misstatement or suppression of facts. And you might understand that order in GST can be under two sections, section 73, section 74. Section 73 basically talks about bona fide case. Section 74 talks about this fraudulent case, fraud, willful misstatement and the suppression of facts. Now they've added this section 74. It is merely just a clarification. Because when you talk about an order of fraud or willful misstatement or suppression of facts, it is only under section 74. So it is only a clarification that they have attached section 74 there, and that is a simple clarification that is given here. So there is no amendment, basically it is only a clarification by adding the section number there, and this amendment is effective from 8th of October 2024. Rather, you can tell the effective date of this amendment is of no use because it is only a clarification. So it was right from the beginning the same way. So this is the amendment there in your section rule 36. There's nothing much, it's only a clarification that has been added. Now when you talk about the other rules which have been affected, which is rule 36, 37, 40, etc., wherever there was reference of GSTR 1, you'll find GSTR 1A, whether it is rule 36, 4A or rule 37A or rule 40, you find GSTR 1A. This in detail we'll understand in written filing chapter, because this is a consequential amendment because of the amendment there in written filing chapter where they have introduced something called as GSTR 1A. So when we understand GSTR 1A, all these points automatically will be there. So wherever, not only this place in ITC chapter, there are a lot of other chapters where you'll find this amendment, and we'll not discuss much about it because it is a constitutional amendment. Wherever in GST Act or rules there was a reference of GSTR 1, they have attached GSTR 1 or as amended form GSTR 1A. So basically it is GSTR 1, or if you have amended it in GSTR 1A, it is GSTR 1A. What is GSTR 1A? What is the impact and all? We'll discuss that in your written filing chapter. So you'll have a great clarity there. And all these amendments with respect to GSTR 1 is all effective from your 10th of July 2024. As I said, even in your document chapter, there's no amendment per se, because this amendment which you're seeing in your rule 48, where they talk about serial number of the invoices should be electronic furnished in GSTR 1. Again, I'm not going into technicality, just they have added or as amended form GSTR 1A. So this amendment again is a consequential amendment because of your amendment in written filing chapter. There is a new form which has been introduced, which is in line with GSTR 1, which is called as GSTR 1, where you can make amendments immediately after filing your GSTR 1. So that will be discussed in your written filing chapter. And all those amendments pertaining to your GSTR 1A are effective from your 10th of July 2024. Right. Now, basically we have seen that in your ITC chapter there are no much amendments. Basically only one important amendment are there. So few amendments are dealing with GSTR 1A, which has got no significance because it is because of 1A being added in written filing chapter. Every place where GSTR 1 was used, they have added 1 and GSTR 1A. So that is the document chapter, no such amendments. Only 1A, 1 and 1A has been added now. In ITC chapter, there was one more amendment which spoke about your ITC cannot be availed if at all someone has paid the tax pursuant to an order of demand because of fraud, willful misstatement and suppression of facts. Basically that was under section 74. They have clarified that it is section 74 case. No amendment. Only amendment that you could find in ITC chapter basically was a time limit when your registration is cancelled and later on that is revoked. So that is an amendment that you could find in your ITC chapter. Now, when you talk about your registration chapter, yes, there are quite a few important amendments that we have to focus on. So when you talk about registration chapter, in section 23, there's a notification which has been released pursuant to section 23, notification 5/2017 CT, where you're not required to take registration in certain cases. When, if at all, you're engaged in making if at all you're engaged in making only and only supplies where the entire tax will be paid under reverse charge mechanism by the recipient, then in that case, supplier need not take registration. Supposing I'm making my supplies and all my outward supplies, I'm not going to pay tax, only my recipients are going to pay tax, then I need not even get registration because I'm not going to contribute much. So it goes this way. Supposing I'm the supplier and there are my multiple recipients, recipient 1, recipient 2, recipient 3. And all my supplies, for all my supplies, it is taxable under RCM, which means my recipient 1, recipient 2 or recipient 3 are going to pay taxes. Then there is a notification by way of notification 5/2017 CT, which tells that I need not get any registration. And the logic is quite clear because I'm not going to pay any tax. So it gives relaxation to the supplier, telling that I need not take any registration. So to that extent, it is very fair. But we are going to discuss in your RCM chapter that they have introduced an RCM entry for metal scrap. Right. So when you talk about metal scrap, they have introduced an RCM entry, which we'll be discussing. Now that entry, metal scrap, when you talk about RCM for goods under section 9.3, which we have already touched upon. So if you recall RCM part, we will have already touched upon that metal scrap when is supplied by a unregistered person to a registered person, it is attracting RCM. Now what may happen is, I am an unregistered person, and if I am supplying to a registered person, it is always under RCM. So I'll be enjoying the benefit of not getting registration because of 5/2017. Because all my supplies, if I am unregistered and opposite person is registered, every time it will be RCM, I will not at all take registration. So what they have done, they have said that this notification 5/2017 CT is not applicable to a person who's engaged in supply of metal scrap under chapter 72 to 81 of first schedule of customs tariff. So this you have already touched in your RCM section 9.3 RCM, where we have discussed about RCM entry. Now please understand that 4/2017 CT rate, when you are talking about RCM for supply of goods under section 9.3, we have already touched that. So if your supply is made of a metal scrap falling under chapter 72 to 81 by unregistered person to registered person, it is always RCM. So now what have they said? I'll take the same example to explain the impact. Now they are telling that this relaxation will not apply. So supposing this supplier is unregistered and all these recipients are registered person. Now if at all this was applicable in a normal scenario, so the earlier example that we had discussed is there in a general scenario. Now we are talking about special scenario where you are talking about your metal scrap, right? So now what is going to happen is, obviously understanding the situation, you will always tell that yes, it is always RCM, it is always RCM, it is always RCM. So basically you will tell that no, 5/2017 CT rate is applicable and this supplier need not get any registration. Now what is clarified is this would not be applicable, which means 5/2017 will not help him, and this supplier may end up in getting registration because of his turnover, which is under section 22, read along with section 23, notification 10/2019 CT. So if his turnover is crossing 40 lakhs or 20 lakhs or 10 lakhs, he might have to take registration or other reasons, because of other reasons. For example, if at all he is making interstate supply of these goods, he might very well have to get registered. So please understand that this notification 5/2017 is not applicable to a person who is dealing with metal scrap being unregistered person and supplying to registered person. Though it is under RCM, it will be under RCM as long as he is getting registered. Now they are telling that he might have to get registration because of various reasons. One reason might be his turnover is crossing 40 lakhs, 10 lakhs, or 20 lakhs or 10 lakhs, as the case may be. Other reason could be he is making interstate supplies. In all such cases, he has to take registration. And please do understand that the moment he's taking registration, it will be a case under FCM. RCM won't be applicable there. Then the recipients need not pay tax. Right? So they are categorically telling that they're just interlinking that RCM entry with this 5 part 2017 CT rate. Yes, when a metal scrap is supplied falling under 72 to 81, chapter 72 to 81 of Customs Tariff Act by an unregistered person to registered person, it is RCM, but not every time. And this supplier might have to get registration because of turnover or because of other reasons. The moment he is registered, no RCM, no relaxation of 2017 CT. He has to take registration and he will end up paying FCM. Because please understand that when I tell about 5 bar 2017 CT rate in a general situation where all the cases are covered under RCM, you are not required to take any registration irrespective of your turnover. So this benefit will not be applicable now to a supplier of metal scrap. So that is the amendment which is brought out in notification 5 bar 2017 CT. The same is effective from your 10th of October 2024. So that is the first amendment in your registration chapter. Now, the second amendment which is there in your registration chapter is there in your Rule 8 4B. So when you talk about your the Rule 8 of CGST rules, there is a rule called as Rule 8 Sub-Rule 4B, which talks about for a risky category assessee who has done Aadhaar authentication. So you have done Aadhaar authentication, but for a risky category assessee, you have to get again biometric identification, biometric verification. So again, biometric based Aadhaar verification you have to do. But for whom? For a risky category assessee, not for all assessees. Supposing you are applying for registration, you are authenticating your Aadhaar. Generally, what will happen? There will be no physical verification. There is no need of biometric Aadhaar authentication again. But selected assessees which are categorized as risky assessees by the system, what will happen? They have to get biometric based Aadhaar authentication again. Now, central government earlier said that they will specify the states where this rule will not apply. Biometric based Aadhaar authentication will not apply. Biometric based Aadhaar authentication is given in Rule 8 4A and it will not apply for the states covered in Rule 8 4B. Now understand that presently, this biometric based Aadhaar authentication is applicable in all the states. There is no relaxation given to any state. So normally central government will give a list where it is not applicable, Now, if you see the non-applicable list, no states are mentioned. Technically, it means that this biometric based Aadhaar authentication which started with Gujarat, then later on went to Puducherry, then Andhra Pradesh, now it is applicable in all the states. So if at all you are selected as a risky assessee by the system where you have done your Aadhaar authentication, but the system is telling that no, there's something that needs to be verified, then you have to undergo the process of biometric based Aadhaar authentication again, and this is applicable in all the states with effect from 10th of July 2024. Now that is the amendment in your Rule 8 Sub-Rule 4B. Moving on, there's an amendment in your cancellation part of registration which is there in your Rule 21. So Rule 21 talks about cancellation of registration by the officer suo motu in certain cases. Now in such a rule, first amendment is very technical, normal amendment that they have added along with if at all your outward supplies in GSTR 1 is more than GSTR 3B, officer may suo motu cancel it. Now they have said that outward supplies in GSTR 1 or as amended GSTR 1A. So this is because of your written filing chapter amendment where they have introduced a concept called as GSTR 1A. So wherever GSTR 1 is there, throughout GST, whether it is Act or rules, they have added GSTR 1A. So that is not so important because that understanding will have in a written filing chapter. This is only a consequential amendment because of change in written filing chapter. But the next amendment is important. If at all you are talking about a situation where you are violating the provision of third or fourth provision of Rule 23(1), then again your registration will be cancelled. No, let us understand this. Assume a situation where your registration has been cancelled, right? And you apply for revocation of cancellation of registration. Your registration was cancelled because you are not filing your returns. So you file your returns, right? So the provision goes in this way. You have to file certain returns till the returns which are due as on date of cancellation, right? And within a particular period of time. So when you file those returns, your registration will become alive again. But that's a attached condition. After your registration is alive, you have to file balance pending returns which are due as on the date of revocation of cancellation within 30 days of revocation of cancellation. Which means if you don't do that, now they've added a provision, your registration again will be cancelled. So this amendments in Rule 21 is effective from 10th of July 2024. Now let me explain the second amendment here. First amendment is only because of return filing process. Assume that your registration is cancelled because of non-filing of returns. You file your pending returns which are due as on cancellation order. So when you do that, your registration is revived again. So that is revocation of cancellation. Revocation of cancellation. Now the first step is your registration is cancelled because of non-filing of returns. You file your pending returns but which are due as on the date of cancellation order. Then your registration is revived again. This again you have to do within a time limit. Your registration is again alive. Now your registration is again alive. Please understand that there's a condition that you have to file the balance pending returns. You have already filed first set of returns. You have to file balance pending returns as due as on your revocation order, because you have got revocation, and this has to be done within 30 days. So this is a condition before you apply for revocation. So first set of pending returns you have to file at a particular date, and this is a condition which you have to satisfy after revocation order. This condition is before revocation application. Before you apply, you have to file your pending returns. So the condition number one is before you file for revocation, file your pending returns which are due as on cancellation order. After you get revocation order, not revocation application, after you get the revocation order, you are becoming alive again. You have to file the balance pending returns as on the revocation order within 30 days. Within 30 days. And if at all you don't satisfy this condition, by any chance, if at all you don't satisfy condition, your registration again will be cancelled. You're back to zero. Your registration was cancelled because of non-filing of returns. Your registration again will be cancelled because of again non-filing of returns. Again because of non-filing of returns, but the second part of pending returns again because of non-filing of returns. So they have added this. So this is the entire flow. Your registration is cancelled because you have not filed your returns. Before you apply for a revocation application, file your pending returns which are due, the due date which is already gone as on the date of cancellation order. You will get a revocation order, which means you have become alive again, your registration is live again. Then they tell the second condition is within 30 days of revocation order, you have to file the balance pending returns due as on the date of revocation order. It will be few returns. Now, if you don't file that within 30 days, you are back to square one. Again, your registration will be cancelled again. So that is given here. Now, when you talk about next amendment in your registration chapter, it is again not a very important amendment. The reason being this amendment is only because of your change in return filing process, Rule 21A, which talks about suspension of registration. So wherever you had GSTR 1, they have added as amended in GSTR 1A. So this is again because of your return filing process. This is a consequent amendment because of your introduction of GSTR 1A in your return filing process. So supplier will file GSTR 1. There are some corrections. You can go with GSTR 1A. Ifs and buts will be touching in your return filing chapter. So this is a consequential amendment effective from 10th of July 2024. Please understand when this GSTR 1A is introduced in return filing chapter, which is a follow-up of GSTR 1. any place in Act or rules where there was a reference of GSTR 1, they have added GSTR 1. I need not focus much on that. Yes, friends, now let us discuss the amendments which are there in your payment chapter. Starting with your Rule 86, which talks about your electronic credit ledger. Again, it is not an important amendment because it is a constitutional amendment because of amendment in your Rule 96, which we'll discuss in your refund chapter. Nevertheless, what have they done is, when you talk about your electronic credit ledger in Rule 86, there was a reference in Rule 86 4b to Rule 96 sub Rule 10. So it was talking about if at all a registered person deposits the amount of erroneous refund. So if he has got erroneous refund and is depositing that again because of section 54 3, he has got the refund, or under Rule 96 3. But there was a reference to 9610 in contravention of Rule 9610. So there was a reference to that particular 9610. Now that Rule 9610, it is not at all that there's no such restriction, which we'll be discussing in detail in your refund chapter. Because of that amendment in Rule 96 sub Rule 10, here this particular impact is there. So because there is no such restriction which is there now in Rule 9610. Previously there was a restriction. When you talk about exports, there are two categories: on payment basis, on under LUT basis without payment. Right. So earlier when you go for export or supply to SEZ on payment basis, and if there were certain notifications where if you opt those notifications, you don't have two options. Normally for zero rated supply, you have two options: on payment basis or under LUT. But for certain notifications, you don't have on payment basis, you can go only under LUT. Now that particular certain notification restriction is removed. Therefore, there is an amendment in Rule 96 sub Rule 10. Therefore, you have an amendment in Rule 86. So in simple terms, you need not focus on this amendment because the amendment has come because of a rule which is Rule 96 sub Rule 10, which is touched in your refund chapter. Right? It's only a consequential amendment effective from 8th of October 2024. Rather, before moving to Rule 88B, which is dealing with interest, I'll touch Rule 88C, which talks about your difference in your GSTR 1 and 3B, difference in liability. Now, whenever there is a difference in liability between GSTR 1 and 3B, as already discussed, the moment they give reference to your GSTR 1, that will always be added along with GSTR 1A. Again, this is nothing but a consequential amendment because of your change in return filing process, where a supplier can file GSTR 1 and followed by, if he wants to do some amendment in GSTR 1A, effective from 10th of July 2024. So again, this is a consequential amendment. Why I am focusing on first your Rule 88C and Rule 86, because both these amendments have got no impact in payment chapter. Something has happened in some other chapter. So in return filing chapter, they have introduced the concept of GSTR 1A. Therefore, there's an amendment in Rule 88C. So technically, there's nothing changed in 88C. And similarly, there's an amendment in refund chapter in Rule 96 sub Rule 10. Because of that amendment, there's an impact in payment chapter Rule 86. Again, technically nothing has changed much in Rule 86. So you need not focus on these rules when you're revising. Now, talking about the rule which has changed something consequentially, not consequentially, which has changed something drastically, is your interest rule. When you're talking about calculating or computing your interest under section 50, right along with your Rule 88B. So here there's actually a change which has come in Rule 88B. Now, what it is telling, normally you pay interest on your gross output liability or net output liability based on the situation. If at all you're filing your return late, but the transaction is reported in the same month return, then interest will be on net output liability. Subject to, it is self-assessed by the SSC and not found by the officer under section 73-74. In cases where the liability is determined by the officer under section 73-74, interest will be on gross output tax liability. And in cases where a transaction of 1 month is reported in another month's return, then again interest will be on gross output tax liability. So this was already very much there. Now, what is amendment? Amendment is not with respect to the principal amount on which interest is computed. It is with respect to period. Now, what is the situation that they are talking about? If at all you have credited that amount, the payment that you have to make in your electronic cash ledger as per your section 49 before the due date of filing the said return, but the same is adjusted against the payment for payment of taxes after the due date of filing of return, this period will not be taken for your interest calculation, as the amount is lying in the ledger from the due date of return till the date of debiting. So what they are trying to tell, that's a due date. You have made the deposit in cash ledger before the due date of return, but used it while filing the return after the due date of return. And in that point of time, the amount remained in cash ledger. So interest won't be calculated on that period. Now let us understand this with the help of an example. Supposing you're talking about your December 2024 return. So the due date of which is, let us talk about a regular taxable person and going under MRMP scheme, monthly return, monthly payment scheme. Now, the due date of this particular return is here 20th of Jan 2025. Assume that for this particular month, your gross output tax liability is 10 lakh, ITC is 7 lakhs. So the net output tax liability that you have to deposit in cash ledger is 3 lakhs. So this amount has to be deposited by way of cash. Now talk about a situation where you have deposited 3 lakhs in electronic cash ledger before due date, that is say 18th of Jan 2025. But you have filed your return and adjusted the amount in cash ledger, which means only when you file your return that amount will be allocated, adjusted against the liability. So when I'm talking about adjustment in cash ledger means this has been adjusted against your liability of 10 lakhs. Totally 10 lakhs is your liability, 7 lakhs is paid by credit ledger and 3 lakhs is paid by cash ledger. Now, your return has been filed, say on 25th of Jan 2025. Please do understand, for late filing of return for 5 days, there will be surely late fees. Now, previously what was happening, for late payment, interest also would have been calculated. So along with your late filing of return for 5 days, 20th Jan to 25th of Jan, there will be a late fees for 5 days. But now what they are telling, normally interest also would have been computed for 5 days. Though you have made the payment on 18th Jan, interest also would have been computed for your 5 days at the rate of 18% per annum, because late payment, technically you have made the payment earlier, but it was considered as late payment. Now what is the logical amendment? They're telling that no interest. Why no interest? The reason is you have deposited this 3 lakhs amount before your due date of payment, 18 Jan. So technically you made the payment in cash ledger. The only fact is in your return it was adjusted on 25th of Jan. Until that point of time, 3 lakhs remained in cash ledger. It should not have been that happened that 3 lakhs again went out from cash ledger. It should have been that during this time limit, 3 lakhs. During this particular time limit, your 3 lakhs was intact in electronic cash ledger. Then they are telling that no interest, because the amount was actually paid in electronic cash ledger before 20th of Jan. The only some procedural thing, that is adjustment against the liability, was done only when your return was filed and your cash ledger was adjusted against your liability ledger, and 25th of Jan we will not charge any interest. So that is this particular amendment. But understand that this amendment has a limited applicability only in a situation where you're depositing the amount in electronic cash ledger. If at all is not depositing the amount in electronic cash ledger, the amount has come through TDS or TCS means, then interest would have been calculated for 5 days. Also, very limited liability. Assume that, first thing, in the same example, if you got the amount in electronic cash ledger by way of TDS or TCS, which has come on 18th of Jan 2025. In that scenario, please understand that there would have been no such relaxation. Interest would have been calculated for 5 days because it is only talking about the payment in cash ledger, not automatically coming in cash ledger. No relaxation. Second situation, if at all the amount would have been deposited in electronic cash ledger on say 22nd of Jan 2025 and followed by filing of return on 25th of Jan 2025, then please understand, even in this case, interest will be for entire 5 days. It won't be there for only 3 days. The same logic will not hold good. So if the amount has come in your electronic cash ledger by way of TDS TCS, though it has come on 18 Jan, but nothing will change. The due date was and you filed your return when? You filed your return on 25th of Jan. We are taking the same example. Though the amount came by way of TDS TCS on 18 Jan, but return was filed on 25th of Jan, this will not be considered. Interest will be calculated for 5 days. Or you have deposited the electronic amount in electronic cash ledger after the due date. You did not deposit before the due date 28th Jan, you deposited on 22nd of Jan and return is filed on 25th of Jan. Even here it will not be helped. Technically, if you apply the same logic, you would have said that interest is only for 3 days. No. This is only when deposit in cash ledger is before due date and return is filed after due date. So this will not be helping you out. Interest will be still for 5 days. So this is the amendment that has come out in your payment chapter calculation of interest, which is effective from your 10th of July 2000. So this is an important thing that you need to remember when you're calculating interest. Yes, there are certain important things that can come up. You can have this in a form of a practical question, but be cautious. This is applicable only when the deposits are made in cash ledger, not automatically coming by way of TDS TCS. Secondly, this is applicable only when the deposit is made before the due date of return and return is filed after the due date of return, not otherwise. So that is an important thing that you need to focus. Now, talking about an amendment which is having a great impact for this amendment for this particular exams is your amendment in your written filing chapter. So your written filing chapter has underwent a draconian change in terms of introduction of GSTR 1A. So that is this thing that we are trying to understand first. Now let us first understand the amendment which has come in your rule 59, which you are talking about filing of your GSTR 1, and the consequent amendment which has come in your rule 60, that is your GSTR 2B. So introduction of GSTR 1A in your rule 59, specifically proviso to rule 59 sub rule 1, right? So that is introduction of GSTR 1A, and correspondingly what is the impact in GSTR 2B, where you're talking about the recipient's point of view, 1A and 2B. So first we'll see amendment in 59, rule 59, and correspondingly what happens in rule 60. So 1A versus 2B. Now first let us understand what is this GSTR 1A. Now government has brought out a new concept called as GSTR 1A, where you can where a supplier is filing GSTR 1 as outward supplies, and if at all there are any amendments, he need not wait for the next return to come. He can include it in the same period return, which is GSTR 1A. He need not add it further. So if at all after filing your GSTR 1, the details of outward supplies. But before filing your GSTR 3B, the supplier at his own option, what he can do? Amend or furnish the additional details. He can either amend or furnish additional details. Portal as of now allows only amendment, but slowly it will allow even additional adding extra details in a form called as GSTR 1A, which is to be filed through common portal, either directly or through notified centers by commissioner. So that is the scenario. So what is this entire thing all about? Supplier, what he does? As a supplier, supplier files his details of outward supplies in a form called as GSTR 1. So supplier will file his outward supplies in GSTR 1. This has to be furnished, and recipient will get that in GSTR 2A and 2B. This was already there. There's a difference between GSTR 2A and 2B. 2A is dynamic, it keeps changing. 2B is static. What we use for written filing basically is GSTR 2B. For annual return, we use GSTR 2A. So that is already there. Now, what has happened is, this is furnishing. So when you talk about supplier doing it, this is furnishing it or filing it, and this is auto-populated. The recipient does anything, it is auto-populated. So supplier files his outward supplies in GSTR 1, sales. In simple language, it is sales in GSTR 1, and recipient get the details of his inward supplies. In simple language, it is purchase in GSTR 2A, which keep changing, and GSTR 2B, which is static. And for written filing process, for normal written filing purposes, we do use GSTR 2B. Only for the purposes of your annual return, we do use your GSTR 2A. Now, what is the change that has been brought out? This particular change is now supplier after filing GSTR 1, but before filing is GSTR 3B, because supplier basically will file two returns. One is GSTR 1, the details of your outward supplies, followed by GSTR 3B. So supplier will file GSTR 1 and GSTR 3B. One will only and only contains the details of outward supplies, but 3B will contain details of outward supplies, that is output tax, inward supplies, that is input tax credit, and payment will be done only in 3B. 1 will not have any payment facility. Now, what is the amendment that has been brought inside? In between this particular time, after you file GSTR 1, but before you file GSTR 3B, a supplier, if at all he has given wrong details in GSTR 1, he can amend that in GSTR 1A. So this again is the details of outward supplies, but what will happen is he'll amend. If at all he has given some wrong information in about a particular transaction in GSTR 1, wrong GST number, he can amend in GSTR 1A. Or assume that if at all that is one supply which has been missed out in GSTR 1, that can be added. So even extra information can be added. Portal is as of now not allowing, but it will surely allow it later. So either you can correct the details given in GSTR 1, or you can give additional information, because when you see the provision, it provides for both. Either you amend it if at all it is wrong, or you add additional details. You can add supplies as well, additional information. Now, what you might ask, what is the advantage of it? The advantage of it is, supposing in GSTR 1 you have given the sales information as say 1 crore, but actually it is 1.5 crores. So you can add that extra 50 lakhs here, and finally in your auto-populated GSTR 3B, though you can change that figures which is coming, what you will file is 1.5 crores. So when finally notices are coming, it will not take the details of 1 and 3B. When notices are coming, it will see 1 along with 1A and 3B. 1 along with 1A in total is 1.5 crores and 3B is 1.5 crores. So it will not give you any notice. Otherwise, what will happen? That 50 lakhs that you have missed out, you'll add it next month. So for the first month, it will be 1 crore in GSTR 1 and 1.5 crores in GSTR 3B. In the next month, there'll be a figure. Supposing next month the turnover is 2 crores. In one, it will be 2 crores plus 50 lakhs that you have missed out. And in 3B, it will be 2 crores. Supposing you're talking about 2 months. April month and May month. April month turnover is 1.5 crores and May month is 2 crores. I'm only talking about your outward supplies. Now let us assume that you don't have GSTR. You don't have GSTR 1A. What would have happened? Supposing by mistake, if at all, you would have reported only 1 crore in GSTR 1, but you realize the mistake in 3B and you report 1.5 crores and pay tax on 1.5 crores output tax. Right? What you should have done? In the next month, you would report 2 crores plus 50 lakhs that is missed out. Plus 50 lakhs that is missed out. And in 3B, you will report the right thing, 2 crores. So what will happen when you compare here 1 versus 3B? So you will find that there is a difference of 50 crores. That is not 50 crores, 50 lakhs here. 0.5 crores here. 1 versus 3B, and here again 0.5 crores. So net effect is 0, but that difference will come. Now what will happen after the introduction of GSTR 1A? If at all you realize or recognize that mistake after filing GSTR 1 but before 3B, you will add that 50 lakhs immediately here. Therefore, there is absolutely no need for you to add it in GSTR 1 of the next month, that is May month, and therefore the difference between 1A compared with 3B will be 0 in both the months. So that is the advantage of your 1A. Right, 1A, please understand that you can file if at all you know that you have committed some mistake in GSTR 1 immediately after 1 but before 3B. So that's the time there. After you file 1 but before you file 3B, you can correct the mistakes by using your GSTR 1A, which will help you in avoiding litigation in future. Otherwise, unnecessarily, there will be questioned by the department, okay, why there is more sales in GSTR 3B in April and why there is less sales in GSTR 3B in May month. So that question could be easily avoided. So it will help you if at all you realize the mistake after filing GSTR 1, but before you file GSTR 3B of the same one. Right, so that is this particular understanding, introduction of GSTR 1A. So whenever you see 1, always you'll find that a lot of points we have already covered. Always you have to see 1 along with 1A in totality. And it is not only additional information, you could correct it. So you have given wrong sales data, wrong GST number of a party, you could change that also. I've taken the extra information of additional information. So that is the purpose of GSTR 1A. The purpose of GSTR 1A. Please understand that 1A can be filed after filing GSTR 1. After you file GSTR 1, but before you file GSTR 3B of the same month. So that is an important thing that you need to remember. Now that in a way helps you out in case whatever additional details that you're filing in GSTR 1A as a supplier immediately filed after the due date of GSTR 1 but before the due date of GSTR 1 of the next month, that will appear in GSTR 2B. So technically it means that it will appear in GSTR 2B of that same month. So whatever extra information that you file of GSTR 1 in form of GSTR 1A after the due date of GSTR 1 of previous tax period. In our example, if at all you have taken April, GSTR 1 due date of March month But before the due date of GSTR1 of current tax period, it will reflect in 2B. Now let us understand what is the impact. And what is the problem also we'll understand. Theoretically, it might not give you the entire meaning. Supposing that is April month, right? And you file GSTR1, we'll continue the same example, showing 1 crore. Right, this GSTR1 showing 1 crore is filed on say 8th of May. Immediately you realize a mistake and you understand that you have missed out 50 lakhs and you report those 50 lakhs, that is 0.5 crores, right? On this was done on 8th of May and this you do it on 10th of May. This you do it as a supplier. This you do it as a supplier. Your output supplies. As a recipient, you'll get the details of your inward supplies. Now, as a recipient, you'll get the details of your inward supplies in your GSTR 2B. So let us not talk about 2A because 2A is used, it's dynamic and it will be used only for your annual return. Let us focus on GSTR 2B. Now, in your GSTR 2B, you will get the information of 1 crore GSTR 2B of which month? The GSTR 2B of April month itself, which means recipient can take the credit in the month of in the return of April filed in May. In the return of April, which is going to be filed in May. What about this one? So, as regard as 1, this will appear in 2B. What about 1A? If you strictly understand, this will also go, supposing there are 2 recipients, 1 crore, 1 sales and 50 lakhs, 1 sales. Let us only assume that there are only 2 sales. One is of 1 crore, one is of 50 lakhs. The first recipient will get that entire 1 crore in GSTR 2B of April. He can take the credit in April return filed in May. Second case also, the second recipient also will get this information in GSTR 2B, which is of 50 lakhs, that is 0.5 crores. Ideally in the same month, because 2B means what? 2B, if at all any details is filed by the supplier, any details which is filed by the supplier in GSTR1, now it is along with GSTR1A before the due date of GST. What is the due date of GSTR1? The due date of GSTR1 is 11th May. This would appear in GSTR 2B of the recipient in April return itself, which is going to be filed in May month. Correct? So not only recipient 1 who has purchased for 1 crore will be able to take the credit, because ITC is available only for the recipient when it is appearing to be. So the recipient will be able to take the credit in April itself, not only recipient 1 but also recipient 2. He will also be able to take the credit in April return itself. This is theoretical. But what is the problem practically? Why? Be it GSTR1 or GST. If at all I have, I have a time limit to file GSTR1 between GSTR1 and 3B. Correct. Between GSTR1 and 3B can also be 10th of May. I need not wait till 18th of May or 19th of May or 20th of May. After I file GSTR1 and before I file GSTR3B, I can always file GSTR1A. So in between period can also be, it could be a scenario where 1 is also filed before due date of GSTR1 and 1 is also filed before due date of GSTR1. Highly possible. But the portal will not allow you to file GSTR1A before due date of GSTR1, which means portal will allow you to file your GSTR1A. Even though you realize your mistake immediately, you file your GSTR1 on 8th of May. You realize that it should have been 1.5 crores, but I have reported only 1 crore. So balance 50 lakhs or 0.5 crores, I have to report it. You try to do it on 10th of May, it will not allow you. only after the due date of GSTR 1 is over, which is 11th of May in a normal scenario, portal will allow you to file your GSTR 1A only after that. Though provision tells that you can file it immediately after filing GSTR 1 and before filing GSTR 3B of the same month. But technically, portal will give you the option of filing GSTR 1A only after due date of GSTR 1 is over. Which means, though you know the mistake on 10th of May itself and you try to add that 50 lakhs, you cannot add it. You can add it only on 12th of May. Now, what is the impact? If you can add that only on 12th of May, for the recipients of 50 lakhs, they will not get this in April GSTR 2B. They will get that information in May GSTR 2B. After the due date of GSTR 1 of April month, but before the due date of GSTR 1 of May month. So what will happen is, the recipients of 50 lakhs or 0.5 crores will be able to take the credit only in May return. Though the supplier has identified the mistake before the GSTR 1 due date and he has already filed GSTR 1, he wants to file GSTR 1A before GSTR 1 due date, but he will not be able to file it. He can file that information only after the due date of GSTR 1, which means as a recipient, those customers who are purchasing for 50 lakhs, they will get those inward supplies information not in April month's GSTR 2B, but only in May month's GSTR 2B, which means they can take the credit only in their May return, not in their April return. So if you look from the angle of recipients who purchase for 1 crore, they will be able to take the credit in April return itself because it has been reflected in GSTR 2B of April because the supplier has filed GSTR 1 before the due date. But that 1A 50 lakhs is filed by the supplier after filing GSTR 1 but before filing GSTR 3B. Now, an additional information is not as per law, it is as per portal. Portal, technically as per law, you can file it after GSTR 1 before GSTR 3B of that one. But portal does that, yes, you can file after GSTR 1 but before GSTR 3B, but only when the GSTR 1 due date is over. So when you understand that, you can file that GSTR 1A after GSTR 1 and even after due date of GSTR 1. After filing GSTR 1, even after due date of filing GSTR 1. Right. Whichever is later. After actual filing of GSTR 1 or due date of GSTR 1, whichever is later, you can file only after that. And that makes the recipient of 50 lakhs get that particular 50 lakhs in their GSTR 2B, not in April but in May return, and they can claim the credit only in May. So that is because of portal. So that amendment is there in your rule 60. So I have explained what is the drastic change in your written filing process with the introduction of GSTR 1A. Not only that, we have understood vis-a-vis GSTR 2B. So rule 59 and rule 60. Now the other places where you have amendments, I'll just highlight it so that we need not go through that again. So there is an amendment again in rule 60 itself, where they talk about 1 and 1 is always read along with 1A. This is a consequential amendment. And by the way, please understand the written filing process has undergone change with effect from your 10th of July 2024. So the consequential amendment also has gone with, which is with effect from 10th of July 2024. In other place of rule 60 also there is a consequential amendment because of 1A. Wherever you find GSTR 1, you will find GSTR 1A. Not only in your rule 60 other part, but also in your rule 78, which is all about your matching of details filed by ECO in GSTR 8 and supplier outward supply is filed in GSTR 1. So 1 along with 1A. That is also with effect from 10th of July 2024. I want to just tell that these are all consequential amendment. Not of much important because the written filing process has undergone change with the introduction of 1A. Wherever you find GSTR 1 in any place in Act or rules, you will find 1 or 1A. Now, the other amendments which are there. Now, the other amendment which is there in Rule 59 itself, specifically Rule 59.4, and There's a new rule which has been introduced, 59.4a. 59.4a is also consequential amendment. Whatever you can report in 1, the same thing you can report in 1a. So I'm not going to touch that particular thing. So you have to report B to B and B to C in different parts. The same thing. 59.4 talks about reporting in GSTR 1, and 59.4a talks about reporting in GSTR 1a. The same thing, additional, same thing, exactly same things. So that is again a consequential amendment. But what is the amendment in 59.4? How to report in 1 as well as 1a. So we are dealing your GSTR 4 as well as your GSTR 1 as well as 1a in terms of 59.4 and 59.4a. So be it your GSTR 1 or GSTR 1a, rule 59.4 or rule 59.4a, what are they trying to tell? If at all it is B2B supplies and B2C supplies. B2B supplies, whether it is interstate or it is intrastate, it has to be reported invoice wise. Same thing, there's no amendment here. So B2C, whether it is interstate or intrastate, generally it is consolidated, but wait, there's a small change here. So this has to be reported. B2B is always have to be reported invoice wise, one by one. If there are 1,000 invoice, 1,000 line items. 1 lakh invoice, 1 lakh line items. B2B. B2C, if it is interstate, supposing I'm there in the state of Tamil Nadu and I'm making supplies outside the state, but my customer is unregistered. B2B means my customer is registered. B2C means my customer is unregistered and my customer is there in other state. If at all, invoice value, the value of that particular transaction is more than 2.5 lakhs. So earlier it was 2.5 lakhs. Now that 2.5 lakhs has changed to 1 lakh. So earlier the limit for reporting B2C interstate was applicable in a case where the invoice value was more than 2.5 lakhs. Now that is reduced to 1 lakh. So that is the amendment. So now 2.5 lakhs is changed to 1 lakh. So that is the amendment that we are talking about. Now it is no more. 2.5 lakhs. This is amended to 1 lakh. If the invoice value, the transaction value is more than 1 lakh, then this also has to be reported invoice wise. Interstate, other cases. It has to be reported consolidatedly. Intrastate, any case means whether the invoice value is more than 1 lakh or less than or equal to 1 lakh, consolidated. Consolidated means one line item. So consolidated transaction will be applicable in a scenario where it is B2C interstate. If it is interstate and if the value is more than 1 lakh means invoice wise. Invoice value is more than 1 lakh. That transaction, supposing there are interstate B2C transaction, there are 1,000 transactions, out of which 5 transactions are more than 1 lakh. Invoice wise, 5 items invoice wise. Other transactions are all less than or equal to 1 lakh. Then what will happen? You can report it consolidated, but consolidated when you're reporting consolidated state wise. It's not all the states one line item. So I have interstate supplies from Tamil Nadu to Maharashtra, and assuming all are less than 1 lakh, one line item I can report. I have hundreds of transactions Tamil Nadu to Maharashtra, interstate B2C. I can report it as one line item. I have hundreds of transactions Tamil Nadu to West Bengal, interstate B2C. I can report it one line. I have hundreds of transactions Tamil Nadu to Delhi, interstate B2C. I can report it one single item, state-wise. I cannot merge states, state-wise. But if I have out of all those hundreds and hundreds of transactions B2C interstate, there are 5 transactions which are having invoice value more than 1 lakh. That I cannot consolidate. That I have to report it line by line. We call it as B2C large. But when it is intrastate, within the state, I have thousands of transactions B2C within Tamil Nadu, within Tamil Nadu. Then I don't see 1 lakh, more than 1 lakh or less than or equal to 1 lakh. Any case, I can report it consolidatedly. B2C Tamil Nadu, one line item. Thousands of transactions, but one line item. So what is the amendment that is there? The amendment which is there is previously B2C large interstate was 2.5 lakhs. Now B2C large interstate is 1 lakh. That is the amendment which is equally applicable in 1A. Now, what is the other important amendment? By the way, last amendment in your return filing chapter is GSTR 4 due date, which is there given in your Rule 62. So, when you talk about your composition scheme dealer, they make payment quarterly, CMP 08, and they file return yearly. Now, the due date for GSTR 4 earlier was 30th April of next financial year. 30 days after the financial year. So 30th April of next financial year. Now from financial year 24-25 onwards, the due date is 30th of June of next financial year. For a composition scheme dealer, yearly GSTR 4 due date is changed from 30th of April of next financial year to 30th of June of next financial year. And this is effective from your 10th of July 2024. So normally when you talk about GSTR 4 due date of any financial year, you tell that after the financial year is over, 30 days, which means 30th April of next financial year. But now that has changed to 30th of June of next financial year. So due date of GSTR 4 has gone a change. That is all about the amendments in return filing chapter. Basically, you'll find 3 core amendments: introduction of 1A and the impact in 2B, due date of GSTR 4, and other amendment is when you talk about B2C interstate transactions, large, definition of large, invoice wise reporting, 2.5 lakhs has changed to 1 lakh. Now talking about the amendment in TDS and TCS. Now they have introduced TDS when you talk about your metal scrap. Metal scrap we have discussed in your RCM chapter. We have also discussed in your registration chapter, and this is the third chapter that discussing TDS. Normally TDS was applicable when you talk about government and government agencies and government companies and government undertakings contract. Now it is only even for, it is not only for those government contracts, but it was also for metal scrap. Any registered person. So when you talk about your TDS, it is given under section 51. Now what is the amendment by virtue of notification 50/2018 CT, where they have added one more list in the TDS applicable parties, that when you talk about your notified persons who are required to deduct TDS, now a registered person who's getting a metal scrap falling under chapter 72 to 81 of first schedule of Customs Tariff Act, if he is purchasing from another registered person, TDS will be applicable. Now this TDS applicability again is with effect from 10th of October 2024. All the amendments dealing with metal scrap is effective from 10th of October 2024. Let us try to understand. Supposing you're talking about supplier being unregistered, recipient 1, recipient 2, recipient 3. Till he is unregistered, and all the recipients assume that they are registered, the recipient will pay under RCM. That is the first amendment. We are talking about the entire discussion is all about metal scrap covered by chapter 72 to 81 of Customs Tariff Act 1975. But understand that supplier cannot remain unregistered for a long time, right? He has to take registration because of the turnover or because of any other reason, which means if his turnover is crossing 40 lakhs, 20 lakhs or 10 lakhs, or if he is making interstate outward supplies, etc., he has to get registration. He will not get the benefit of 5/2017 CT. So that is the second amendment. Now assume that after some point of time the supplier is doing a great business and he is registered. Now suddenly the supplier becomes registered. The recipients, the same recipients are there. So till one point of time, he was unregistered. Now the same supplier has become big. He is starting having turnover which is more than 40 lakhs, 20 lakhs, 10 lakhs as the case may be, or he started making interstate outward supplies or any other reason. For any other reason, he has got registered. Now the moment he is registered, all the transactions are taxed under FCM. No more RCM. RCM is applicable only if the metal scrap is supplied by unregistered supplier to registered recipient. Now it is no more RCM. But what will happen is these recipients will now deduct TDS. Supplier will charge GST on their invoice FCM, but these recipients will now deduct TDS. These recipients now will file your GST as 7, and this TDS amount they will pay by cash, and the supplier will get in cash ledger. So till that is some work for the recipient. If supplier is unregistered, recipients who have registered have to pay under RCM. If supplier becomes registered, now it is no more RCM. But these recipients who are registered, supplier is also registered, recipient is also registered. They have to deduct TDS, they have to file an additional return. They have to take one more registration and they have to file GST as 7. GST as 7, they will deduct and pay TDS in cash ledger in a separate return GST as 7, and the opposite person, supplier, will get that amount in his cash ledger. That is the entire amendment with respect to metal scrap covered by your chapter 72 to 81 of Customs Tariff Act. All these provisions are effective from 10th of October 2024. There's another amendment which is there in this chapter, but now with respect to TCS. The earlier was section 51 TDS, now it is with respect to section 52 TCS. TCS is applicable when you are supplying goods or services through electronic commerce operator, where section 95 is not applicable, and consideration is also routed through ECO. Supplies through ECO, consideration is through ECO. Please understand, earlier the rate of TDS was 2%, now also it is 2%. Earlier the rate of TCS, maximum rate is 2%, but notified rate was 1%. Now that 1% is reduced to 0.5%. So your TDS rate remains 2%. TCS rate, which was 1%, is changed to 0.5% with respect your notification 15/2024 read with 1/2024 IT. 15/2024 CT read with 1/2024 IT. The TCS rate is reduced from 1% to 0.5% with effect from 10th of July 2024. Please understand, TDS rate was 2%, it remains 2%. TCS rate was 1%, it is now changed to 0.5%. If I tell 0.5%, if it is CGST, SGST, TCS, it is 0.25, 0.25. And if it is IGST, TCS, it is 0.5%. So that is the amendment which is there in your TDS chapter. Introduction of TDS for metal scrap when supplier is registered and recipient is also registered, and the rate of TCS, which was earlier 1%, section tells maximum 2%, but it was 1% till 10th of July 2024. Now it is reduced to 0.5%. Yes, friends, now let us discuss about the amendments in your demand and recovery chapter. Basically, demand and recovery chapter, there are basically no much conceptual amendments. The few amendments that are there are purely procedural. Now, what is the first amendment that has come out in your Rule 142, which deals with your notice and order for your demand of amount payable under the Act, which means what are the forms. Now, Rule 142 basically has come out with an amendment where they are talking about once the assessee is making a voluntary payment in DSC 03, the officer earlier used to give your DSC 04. Now what has happened is, there's an assessee who has got any notice under section 73 or 74, and before he gets an order, he is making the payment. Now what he can do, he has to inform that payment by way of form DRC 03, which was already there. What is happening is he has not got the order. So this is all pre-order. He just got a notice. He can make the voluntary payment by DRC 03 and he'll get an acknowledgement by way of DRC 04. That would be automatically through portal. Now you might ask, what is the amendment? Whether earlier DRC 03 was there? Yes, for voluntary payment by the SSC. Earlier also there was something called as DRC 03 which was there and which is still there. The difference is earlier the acknowledgement in DRC 04 was given by the proper officer, but now it will be automatically given by the portal. So that acknowledgement which was given by proper officer manually after verifying it, now it will not be done. The moment there's a notice under section 73 or 74 or due to any other reason, SSC is making the voluntary payment before getting the order and he files DRC 03 for that, portal automatically will give DRC 04 as an acknowledgement. Now this is with effect from here 10th of July 2024. Automatic acknowledgement in DRC 04 against a voluntary payment by SSC in DRC 03 is the crux of the amendment. Now there is another amendment in the same rule 142. Previously it was your rule 142 sub rule 2. Now it is there in rule 142 sub rule 2a and sub rule 2b. Now understand what is the amendment that is there. If at all you're talking about a situation where there's a partial payment made by a person against the liability, he has to, officer has given DRC 01A, which is pre-notice DRC 01. So there's a concept called as DRC 1A, which is an intimation, not the notice, pre-notice. And officer has given that, he will give it in part A of DRC 01A. SSC has given the submission in part B of DRC 01A. Now what is required is, officer thereafter has to give an intimation in part C of DRC 1A, accepting either the payment or the submission or both. So before notice, there's a concept called as pre-intimation. Before notice, DRC 01A. Officer will give that in part A. So this would be given by the officer. Will give this intimation in part A. SSC will reply, give his submissions. SSC will give his submissions. It may or may not be with payment. He may pay or he may not pay. And if he's paying, he'll pay by voluntary DRC 03, against which he'll get an automatic acknowledgement DRC 04. So that will be done in part B of DRC 01. And this was already there. Now what is the amendment is, after SSC gives a summation in part B of DRC 01A with or without payment, officer is going to give an intimation in part C. So that is the amendment. He is going to give an intimation in part C of DRC 01A for payment or submission, accepting that yes, I've taken your submissions or payment. And if he feels he has to proceed forward, then he'll proceed with the notice that is DRC 01. So that is that. That is the first amendment in your rule 142 2A. Now there is a new rule introduced called as rule 142 2B. Now this is when an order is issued. Whenever there's a tax, interest, penalty or any other amount which is payable because of an order under section 52 or 73 or 74 or 76 or 122, 123, 124, 125, 127, 129. Rather, they have given all those sections where an order can be given. Simple language, there is an order given against a SSC. Right? And SSC has made the payment by DRC 03 under rule 142 2. Now, understand that whenever an order is given, it will create a liability. So, whatever we were discussing, the amendment in your rule 142 2 or 142 2A, these were all before notice stages, before order. So, it was before order. Notice is given, but before order. Now, what we are discussing in 142 2B is after order. An order is given which creates a liability in electronic liability ledger. And assessee has made that payment through DRC 03, right? Instead of this has to be paid against the liability in PMT 01. Actually, this has to be closed against the liability which is created in PMT 01. So it should have been closed by PMT 01. When a liability is created, the closure should not be by DRC 03. It should have been by PMT 01. But assessee has used DRC 03. Now what they tell, this liability should have been closed by using PMT 01. There is also a different form for that. But assessee has closed it by DRC 03. What will happen? There's a liability which is created. Assessee is also paid, but DRC 03. But that liability is not closed. So to explain in a very simple context, because of the order, there's a liability which is created in electronic liability ledger. And this liability should have been closed by PMT 01. This is order which is creating liability, and this is payment which is closing the liability. So this should have been closed by PMT 03. But instead of that, assessee has filed a voluntary channel DRC 03. He has made the payment. He has made the payment. But he has not filed it against PMT 01. He has not filed PMT 01, which would have closed the liability. He has filed DRC 03. Now what will happen? The liability will still remain. Because for closing the liability created by an order, the right format would have been filing PMT 01. But what assessee has done? Filed DRC 03. Which means assessee has made the payment, but liability still exists. Now for that purposes, what they have done? They have said that no problem. You give the details of the payment which you have made by DRC 03 in a form called as DRC 03A, which will be adjusted against PMT 01. So whatever payment you have made by DRC 03 form, you have made the payment. The closure should have been by PMT 01 form, not against DRC 03 form. Now you file DRC 03A and link it with your PMT 01. So this DRC 03A, what will happen? This person will file DRC 03A and intimate whatever he has paid through DRC 03, he'll file a DRC 03A, that the amount would be now credited against PMT 01, which means there's a debit liability already created. Now it would be credited against that particular liability. This will solve the purpose. You have made the payment against the liability, but form selection was wrong. You should have selected PMT 01 and the liability would have been closed, but you have selected DRC 03. Now what you do? You link that DRC 03 with PMT 01. The linkage of your DRC 03 with PMT 01 is now via DRC 03. So that is only a procedural aspect. And also understand, this would not be applicable in a situation where officer has already given order in DRC 05 closing the amount paid via DRC 03. See why it is required for closing the liability. If officer per se has closed the liability by giving an order in DRC 05 against the voluntary payment in DRC 03 itself, the liability is already closed. So 3A is not at all required. Simple. This is required where your liability is created because of the order and the payment is made, but the payment should have been closed by PMT 01, but it is not closed. You have used DRC 03. Now the liability still remains. You have not got the order. To connect DRC 03 with PMT 01 for closing the liability, DRC 03 is required. But if against this payment, order is already given in DRC 05, already closing the liability, then this entire 3A will not be required. So this is the amendment, procedural amendment, effective from your 10th of July 2024. right? So as I said, these are only procedural amendments, not having much impact for your exam, so not so important for your exams. Now, yes, there's quite a few amendments which has come in your refund chapter. And before we take these amendments, we'll make sure that we split the amendments in multiple formats. One, the amendment which has come because of amendment in return filing process, because of introduction of GSTR 1A, consequential amendments, not at all important. Second, the amendment which has come because of amendment in Rule 96 sub Rule 10. Right, that is the second part of the amendment. Third amendment, which is again because of Rule 96, where you're talking about certain upward revision in price for the export of goods. And fourth, other amendments. 2 or 3 other amendments are there. So what will happen is, your refund amendments could be easily understood in these 4 parts. 1, the amendments which are because of GSTR 1A, consequential amendment. There is a new concept called as GSTR 1A in your return filing process, and wherever 1 was used, it will be 1 read along with 1A. So those amendments are of no use. So you have few cases where there are consequential amendments because of your GSTR 1A. Like there is a Rule 96 sub Rule 1B. So here you have amendment here because of GSTR 1A. Also the same is there in your Rule 96 sub Rule 2. This is purely consequential amendment due to amendment in your return filing process effective from your 10th of July 2024. So not at all important, ignore them. Not at all important, ignore them. Also there's the same kind of amendment in your Rule 96 capital A sub Rule 2, where they have made reference to GSTR 1, they have added GSTR 1A purely because of consequent it is nothing but a consequential amendment because of changing your return filing process effective from your 10th of July 2024. Not at all important, not at all significant. These are all consequential amendments. You can ignore them in totality. Now second, so first what we have seen, there are few cases, one in 96 and one in 96 capital A. Wherever they have used GSTR 1, it has to be read along with GSTR 1 as amended by GSTR 1. That's it. Now, other amendments. Second part of amendment is amendment in Rule 96 sub Rule 10. Now, what is the amendment in Rule 96 sub Rule 10? So, there is an amendment in Rule 96 sub Rule 10 which talks about the refund of IGST on your paid on goods and services exported out of India. So when the goods and services are exported out of India, you have 2 options. Pay IGST, get the refund of entire IGST paid, or don't pay IGST, go under LUT or bond, letter of undertaking bond, and get the refund of only of the unutilized ITC formula basis. Now, there was a Rule 96 sub Rule 10 which was telling that you cannot go for refund of IGST on export of goods and services if at all you're taking the benefit of certain notifications. Certain notifications where you're talking about notification in terms of your foreign trade policy, 40 bar 2017 CT rate, 41 bar 2017 IT rate, where you have received supplies under even notification 48 by 2017 CT, rather you have received the goods under without payment of import duties. These are all foreign trade policies benefits where you have received supplies under notification 48/2017 CT. There is an exception which deals with EPCG schemes. We can receive capital goods but not inputs. So that was the restriction. If you have received inputs under advance authorization, then you cannot go for refund of IGST on export of goods. If you imported the goods and you imported the goods under advance authorization without payment of import duty, and subsequently when you're exporting the same, you have to go only on export on LUT basis, bond basis. You cannot go for export on payment of IGST and get the refund. Now that is removed. Even if you have imported something on advance authorization, taking the benefit of 48/2017 CT without payment of import duty, you can still export the product, the same product, or after manufacturing the final product, you can still export on payment of IGST basis. That is the first amendment. Second, if at all you have taken the benefit of notification 78/2017 customs or 79/2079 customs, again, it is the same concept where you enjoy the benefit, where you have enjoyed the benefit of advance authorization, or even you have enjoyed the benefit of, rather when you talk about 48/2017, you have enjoyed the benefit of purchasing at 0.1% penultimate export. Either you have enjoyed the benefit of advance authorization or you have enjoyed the benefit of purchasing at 0.1%, which means penultimate export, you have purchased something at 0.1% and then exporting it, or you have imported the goods without payment of import duty, now exported it. Right, so to put in a simple way, purchase, export, purchase, export. So if at all you're talking about your inward supplies, purchases, and subsequently there is export. Right, either your purchase taking the benefit of 48/2017 means you have taken the benefit of penultimate export. You have paid only 0.1% on your purchases. Right, earlier if you have done that, you can export only on LUT or bond. Now they have said that no, you can also go on payment of IGST basis. It is your option. Like for all other cases, you have two options: either go on export under a letter of undertaking or bond, don't pay any output tax but claim the refund of unutilized ITC, or pay the entire output IGST on exports and they take the refund of that entire output IGST. Now you can go for both. So this restriction which was there, if you purchase at 0.1%, you cannot go for payment on IGST basis and that refund of, take the entire refund of that. This is now not there. Or you have purchased, your imports are there. Your imports are there on advance authorization or duty free import authorization. Your imports are there under customs notifications. Now if you're importing, which means you have technically paid zero import duty. Now if you're exporting it, earlier you can export only under letter of undertaking or bond. Now they have said that no worries, you've imported an item against advance authorization or duty free import authorization without payment of any import duty. If you export later, as such or after manufacturing, either you can export under LUT or bond, don't pay output IGST, get the refund of unutilized credit as per formula, or you can pay the output IGST, get the entire refund later. So earlier, where if you have imported something against advance authorization or duty free import authorization without payment of import duty, you could not have gone for exporting it under payment of IGST basis. The only option was export the item or the finished goods only on letter of undertaking or bond and then take the refund of unutilized ITC. The reason is here you have paid very less or no input tax. You have paid very less. Either you have paid very less input tax to the supplier, or you have paid no input tax on your imports. So they said that no, if you have not paid something on your purchases, very less or less, then why to give you entire benefit, because when you go on payment option, you will pay the entire output IGST tax, not using this credit but some other credit, and take the entire refund immediately. Automatic refund is there for export of goods, not for export of services. Now what they're telling, let it be. If assessor is enjoying it, if assessor is planning, let him plan. Even if he has purchased with payment of no taxes or very less taxes, he can still enjoy going for exports on payment of IGST using the other credit, not this credit, using the other credit and getting the refund immediately. That is open. So this is rule 96 sub rule 10 effective from your 8th of October. This is the background. Because of this, there are other amendments. Because of this, giving one-to-one refund. This one-to-one refund was given for what? This one-to-one refund was given for your 89 4A, where you're talking about 0.1 percentage purchases, 48 by 2017 CT, or 89 4B, where you're talking about receiving supplies against your 40 bar 2017 CT rate or 41 bar 2017 IT rate, or getting the benefit of customs notification 78 bar 2017 or 79 bar 2017, whatever it is. So they were getting one-to-one refund. If you have taken your purchases without tax or with very less tax, then your export could have been only on LUT or bond basis, and you will get one-to-one refund, not all the refund. So that one-to-one refund concept is entirely removed with the same effect, 8th of October 2024, because there is an amendment in 9610. Now they tell that let it be. Let this particular exporter who has purchased his inputs at no tax or very less tax, why he is not allowed to take the benefit of other credit? So he can export now on payment of IGST basis and take the full refund of that IGST. Or if he is wishing to export under LUT or bond, let there be not one-to-one linkage refund, let there be common refund. So they have removed 89 4A, 89 4B, which was talking about refund in case of exports where the purchases were done at very less taxes or no taxes. One-to-one linkage was required. They tell that let this concept be removed. Let the assessee plan, let the exporter plan his activities. And because 89 4A and 89 4B are amended, what has happened in 89 4, which is the main refund provision, in 89 4, where you're going for LUT or bond, they have removed the reference of 89 4A 4B. They removed the reference of 89 4A 4B. So what they have said in nutshell, that let the exporter purchase the goods, be it import also, at a very less rate of tax within India or at no tax if it is import. Let him do that. Now, first amendment, he still can go for payment on IGST basis. He can still enjoy. He has, like any other exporter, he is having two options. Either don't pay output IGST, go on LUT or bond, or pay output IGST and take the entire refund. Now, if at all he is going for payment of IGST basis, he'll be using other credit. He'll be utilizing credit of other purchases and encashing it. Let him do it. And if at all he is going on LUT or bond, he need not go in a separate one-to-one formula. He need not go for 89 4A or 89 4B. He need not go for one-to-one formula, which tells that no, you have to link your exports with corresponding purchases. One-to-one linkage is very complicated. One-to-one linkage. They said that remove this complication. Let him go for refund of unutilized ITC. Here it is refund of entire output IGST paid, which might have been paid by cash or might have been paid by using credit. That credit could be belonging to other purchases, let it be. So you have two options. Either pay the refund of either pay the entire output IGST and get the refund of entire output IGST. That output IGST might have been paid by cash or by using credit, and that credit might not be dealing necessarily with that corresponding purchases. It can be any credit, other purchases also. So that benefit they are given. Or if the export is going on LUT or bond, then as earlier, if you are purchasing your items at a less rate or no taxes, you will have to link for refund one-to-one linkage 89.4a, 89.4b. Now telling no, not required. Let it be clubbed with normal case, normal exports. Whether he is purchasing with less rate of tax or no rate of tax or normal rate of tax, club everything and use a formula. So here he'll get the refund of unutilized ITC by applying the common formula in rule 89.4. So the ITC of inputs and input services multiplied by all exports, including these exports, divided by total turnover. So we can get that. So that is the amendment which has come out related to your rule 96.10. So that is the second amendment. If you see the bird's eye view of amendments in refund, how we have discussed this. First, refund which are merely time pass. Second, refund because of the amendment which has come in rule 96.10 that we have completed. Now again the refund which is because of rule 96 but dealing with upward revision of price in case of export of goods. So that is the third category of the refund which we have to discuss now. Now what is said, I could have exported my goods, and for export of goods there's a concept called as automatic refund in rule 96. So this is only for export of goods. So what is happening in 96 is 96 rule 96 sub rule 1c. I have exported my goods. I'm only talking about goods on payment of IGST, which means I have paid the output IGST. I'll get the refund of entire output IGST. And subsequently, I have an upward revision. I have increased my price. Now, when I have increased my price, I did not apply for any refund application. It automatically came. For increase in price, I can file for refund of tax on that increase in price in RFD 01 for refund of that additional IGST paid, because I exported the goods, I paid output IGST, I got the refund automatically. Now if there is an increase in price of those goods, I am paying the output IGST, I'll get the output IGST refund, but additional output IGST refund, but not automatically. I have to make an application in RFD 01 for that upward revision in price of goods which have been exported after getting the amount of IGST at the time of export, which is automatically refunded to me. So what is happening? First thing, you understand that it is dealing only with export of goods, and it is covering only in a scenario where you have gone for payment of IGST and subsequent refund. You have not gone for LUT or bond option. If you have gone for LUT or bond option, this is not applicable. You could have gone, but you have gone for payment of IGST. So you exported the goods, you filed your shipping bill or bill of export, and you filed your GSTR1 and GSTR3B. So you filed your customs document and GST returns. This payment of IGST, you will get an automatic refund of IGST. Automatic refund of your output IGST. Why? By linking your customs document, shipping bill or bill of export with GST returns, GSTR1 and 3B. Automatically you will get the refund. If everything is matching, automatically you will get the refund. Subsequently, what is happening is there is increase in price for this export of goods. You have increased the price. Supposing export of goods, let us give numbers now. Supporting export of goods was 1 crore and rate of tax was 18 lakhs. You paid 18 lakhs, you automatically got 18 lakhs. When you paid 18 lakhs, you would have used your ITC or you would have paid by cash, but this entire 18 lakhs came in your bank. Payment of 18 lakhs could have been by using input tax credit or by cash ledger, but the entire 18 lakhs came back. Now there is increase in price. Supposing there is an increase in price, we have assumed the rate of tax as 18%. Now supposing there is an increase in price to the extent of 10 lakhs. Now please understand that again for this increase in price, you will pay additional IGST. You'll pay that additional IGST of 1.8 lakhs. Now, this additional IGST of 1.8 lakhs, you'll not get the refund automatically. This is not automatically. You have to apply. You have to make an application for refund. Because this will not be there in shipping bill of export. You have to make the application for refund of this additional IGST, and that refund will be a normal refund from RFD01. So the first refund was your automatic refund. Here you have to make an application in RFD01. So you'll get the refund. When you make this refund application, you'll get this 1.8 lakhs. Again, when you pay this additional output IGST, you will be using your credit ledger or your cash ledger. But when you get this amount, you will get that in your bank. That is always there in your export. Export will give you benefits. It will encash your credit ledger as well. Understand what is the situation again. There was export of goods. The goods are having 18%. You exported the goods for 1 crore. You paid output IGST. So this is not a scenario where you have gone for LUT or bond. You paid output IGST of 18 lakhs. Automatically you got the refund of 18 lakhs. You paid it by credit or cash ledger, you got in your bank. How it is automatic? Because it links your customs document, shipping bill or bill of export, and your GST returns, GST 1 and 3. If everything is matching, automatically you'll get. Subsequently, what is happening? There is an increase in price of export of goods to the extent of 10 lakhs. And 10 lakhs multiplied by 18%, now you have to pay additional output tax of 1.8 lakhs. So you pay additional output IGST of 1.85 lakhs either through credit ledger or cash ledger. Now you will not get the automatic refund because documents are done. Shipping bill cannot have this. Shipping bill. Your shipping bill will have, shipping bill or bill of export will have only 1 crore. It will not have this 10 lakhs. Your shipping will not have this 10 lakhs. So what will happen is you will not get automatic refund. You have to apply for this additional refund of 1.8 lakhs, which you'll get in bank in RFD01. So that is the amendment which is there, which is with effect from your 10th of July 2024. Now when this has come out, there are consequential amendments. What are the consequential amendments which are there? The first consequential amendment is that you will be making a refund application. So as I explained, if at all you have exporting the goods, you paid IGST, automatically the refund was sanctioned, then there is an increase in price where you have paid IGST again, but now for additional IGST refund, you have to make a refund application separately. Now you might wonder, so why it is not there for export of services? Because for export of services, for upward revision in prices for export of services, there is no separate provision like this, because export of services, even the refund of original IGST, the primary refund, first refund was 18 lakhs. That also is not automatic, that is only manual application. So if you think that why it is there for only for export of goods and not that for export of services, because automatic refund concept is only there in export of goods. For export of services, the initial refund of 18 lakhs also you have to make refund application. This also you have to make a refund application. So that is not at all there. Now please understand that this refund of additional refund of 2 lakhs, additional refund of that increase in output IGST paid for increase in price of goods after export, this additional refund application has to be given within 2 years of export. So here there's a clarification that this additional refund application that you make, the relevant date will be 2 years from the date of export. This proviso we are not discussing in detail. Why this proviso tells that if at all before this rule came out in 10th of July 2024, if it was done before that, then 2 years will start from 10th of July 2024. It is only time being rule. So that proviso you can totally ignore, because proviso talks about a particular time. If you are coming in the situation where export was done before 10th of July 2024, increase in price was all before 10th of July 2024, then for such cases, this 2 years will start from 10th of July 2024. Forget about it. But normally, for this additional refund also, you'll have a time limit. The time limit is 2 years from the date of export, because 2 years is from a relevant date given in explanation, clause A, explanation 2 of section 54, which means 2 years from the date of export. So that time limit is again clarified in Rule 89 1B. And also, other thing that is given for this particular refund in Rule 89, Rule 89 2 double B, they are giving the procedure, what all documents you have to give. Normal documents. For this additional IGST refund, what all documents you are going to submit. You are going to submit your export invoices. You have to give a number and date of export invoices along with copy of such invoices. You have to give shipping bill of exports, number and date along with the copy of such cases. You have to give number and date of bank realization certificate or foreign inwards remittance certificate against those shipping bill or bill of exports along with the copy of the same. And you have to give the details of refund already sanctioned, automatically refund already sanctioned in Rule 96 sub Rule 3. So this is the original. This is all about your original refund, which was automatic. Now you're talking about what are the extra details that you have to submit. These details again you have to submit, plus you have to submit the details of extra details for the additional refund. Additional refund, which is not automatic, which you have to make by way of application. Basically, you're talking about additional refund only. You have to submit the original refund details and extra details. So what you have to give now? You have to give the debit note or supplementary invoice details, which is for your upward revision in prices, number and date along with the copy of the same, and proof that you have paid that additional IGST. Again, you have to give the foreign inward remittance certificate or bank realization certificate for that additional amount. So you have charged, initially you have charged for export 1 crore, now you are charging extra 10 lakhs. So first you have to give that, on that 10 lakhs I have paid 1.8 lakhs. So for that 10 lakhs I have given the supplementary invoice or debit note, and on that 10 lakhs I have paid 1.8 lakhs. I have to give the proof that I have already paid output IGC on that, and that 10 lakhs that I am going to receive extra from my customer outside India. For that I have to give the copy of FIRC or BRC, number and date along with the copy of the same. For that FIRC or BRC, along normally for original 1 crore, I'll give only BRC or FIRC. For that extra 10 lakhs, I'll give BRC or FIRC along with a certificate from a practicing chart accountant or a cost accountant that this amount pertains to upward revision in price because of export of goods. Then the document or the contract because of which I was allowed to revise the price upward. So I have to give the reason why I have revised the price. Initially export was worth 1 crore. Now why I am charging extra 10 lakhs. So that contract or any documentary evidence why the price was actually revised. Also, I need to give a reconciliation statement that this transaction initially was for 1 crore. Now it is increased to 1.1 crore. So I have to give the copy of original invoices, supplementary invoices. If at all there were some discounts, credit notes, that I also give along with matching it with what I have received, what I have charged. I have charged 1 crore initially on invoice, debit note 10 lakhs. Supposing in between I have given some discount of 2 lakhs. Finally, I would have received 1 crore plus 10 lakhs minus 2 lakhs. So credit note would be there. Though I will not get the benefit, but credit note would be there. So here, for that credit note, there's a point that I have to refund back again that refund back that IGST pertaining to credit note. If there is an increase, I have to pay additional output IGST. I'll get the refund of that. If there is a credit note, I can reverse the output IGST. Also, I have to repay that extra refund. So that is there in the circular. So what is given is I have to give a reconciliation statement what I have charged in my invoice, supplementary invoice, additionally charged, less credit note, along with what I have received through my BRC or FIRC. So I have to give that in that particular case. So what is given is, if at all I am claiming that additional refund by way of separate application of output IGST because of upward revision of price in case of export of goods. These are the extra information. Basic information is my original invoices, shipping bill of export, and BRC or FIRC for those original 1 crore rupees, and the refund which is automatically come to my pocket. Then extra is my supplementary invoice, debit note for that particular extra 10 lakhs, prove that on extra 10 lakhs I have already paid 1.8 lakhs, that proof that I have to give. Subsequently, for that extra 10 lakhs, am I receiving the amount, the proof of the receipt of that amount, BRC or FIRC, along with, for this extra 10 lakhs, BRC, FIRC will not be sufficient, CA or cost accountant certificate will be required. And why I am increasing 1 crore to 1.1 crore, why I am getting extra 10 lakhs, contract or any statement or any documents which is supporting why I am revising the price. And finally, a reconciliation statement reconciling what did I charge in my invoice, supplementary invoice, debit note, less credit note, and what I'm actually receiving through BRC or FIRC. So that has to be submitted. When you talk about this entire refund of additional output IGST paid on upward revision of price in case of export of goods is effective from 10th of July 2024. Now, if you look this chart, initially I said that refund amendments will be discussing in 4 parts. 1, consequential amendment because of change in return filing process, GSTR 1A. Second, Rule 9610, where I have purchased or imported my inputs at no tax or without tax or less tax, but now I have the doors open for payment of IGST option. I can pay output IGST and get the refund of entire output IGST, or I can still go for LUT or bond, and refund will be of unutilized ITC, but normal rule 89.4, no concept of rule 89.4A, 4B 1-to-1 linkage. Third, I've exported the goods on payment of IGC basis, not under LUT or bond. It can be done, but we are not discussing about the case. Got automatic refund. Subsequently, there was upward revision of price in case of export of goods. I paid the additional output IGC. Now, the refund of that additional output IGST will not be automatic, it will be by a refund application. Time limit is same, 2 years from the date of export, not from the date of revision of price. And the procedure. Lastly, the other amendments. There are small other amendments which are there. The first other amendment is introduction of a new rule called as Rule 95B, which is there for refund of tax paid on inward supplies in case where the goods are received by canteen stores department. So Rule 95B talks about a situation, very specific situation, where refund of tax is paid on inward supplies where the goods are received by canteen stores department. We are talking about persons holding UIN, unique identification number, but not any other person, specifically persons we are talking about received by canteen stores department. So canteen stores department of Ministry of Defense will receive the goods with tax. When they are supplying it to certain notified persons, they will not pay output tax. Generally, if you don't pay output tax, you will not get the credit. True. Here also they are not paying output tax, they don't get the credit. But the tax paid on inward supplies, they will get the refund. So canteen stores department will have inward supplies and outward supplies. When outward supplies are to notified persons, they don't pay output tax. But on inward supplies, input tax is already paid, but they cannot get the refund. They cannot get the credit. Because when you don't pay output tax, you will not get the credit. But this inward supply, supposing inward supplies was for 100 plus 18. Outward supply is for 200. And no tax. Zero tax. So your output tax is 0, but your input tax is 18 rupees. the credit of which you will not get. You won't get the credit. The supplier will collect 18 rupees from you and give it to the government, but you can apply for the refund of input tax on inward supplies, 80 rupees. As a canteen stores department, you will pay to the supplier 100 plus 18. Supplier will pay 18 to the government, keep 100 with himself. Again, canteen stores department can go and apply for refund of that particular 18 rupees. Now, what is the procedure for them? Normally, the procedure is given in Rule 95, but here it is mentioned that notwithstanding anything contained in Rule 95, Canteen Stores Department under Ministry of Defence will not be eligible for entire refund, will be eligible for 50% refund. So I have to change small bit. Refund will not be of entire 18, refund will be of only 50%. Right. So Canteen Stores Department at the time of the purchase, they would have paid 100 plus 18 to the supplier. Supplier would have paid 80 to the government, keeping 100 with themselves. And Canteen Stores Department will not get the refund of entire 18, only 50% of the taxes on all the inward supplies of goods received by them. But condition is subsequent supply should be to notified persons. Who are the notified persons? Unit run canteens, their own unit run canteens of the Canteen Stores Department, or authorized customers of Canteen Stores Department, which are basically military families or army families. So they have purchased, they paid tax, and they cannot supply to anyone. They should either supply to the unit run canteens of Canteen Stores Department, which are there across India, or through authorized customers. Generally, who will be the authorized customers? Family members of the army persons, as per section 55. They will not file refund in the normal form. They will file in a special form, which is GST RFD 10A. All the provisions for GST RFD 10A will be similar to what is there for GST RFD 1. So it will be treated like a normal refund application, though it is a special form, but not treated like normal refund application. Now, the refund will be available subject to conditions. Right? They have to give the details of inward supplies along with the tax invoice, which have been furnished by the supplier in their GSTR 1, right along with 1A. And supplier should have paid the tax, which means the supplier should have filed that particular invoice in the GSTR 1, right along with 1A, and should have paid the tax in GSTR 3B. Give the details of supplier, name and GST and number of the supplier, which means the supplier should have paid the tax, filed GSTR 1 and 3B for his returns. And in that particular invoice, Canteen Stores Department name and GST should be mentioned. So supplier is filing his 1 and 3B properly, plus supplier is giving the invoice to Canteen Stores Department, where Canteen Store Department finds the name and GST number of Canteen Stores Department, and Canteen Stores Department makes sure that these inward supplies are only and only given to unit run canteens of Canteen Stores Department or the two authorized customers. So these are the documents. They have to give an undertaking that we have purchased from a supplier who has filed properly GSTR 1 or 1A and paid the taxes properly and filed GSTR 3B. In the invoice of the supplier, we find our name and our GST number, and we promise that we have further supplied. This is all about inward supplies. This is everything about your inward supplies. And about outward supply, they promise that we have sold only to unit run canteens of Canteen Stores Department or to authorized customers. Though we have not paid output tax, we confirm that we have only supplied to them. So that is a special refund application, GST RFD 10A, introduced with effect from 10th of July 2024. So this is one of the other cases of refund where there is an amendment. And there's one more last case where there's an amendment in Rule 96A, capital A, 1B. Normally, when you talk about export of services, they give you a time that you have to get the foreign currency within 1 year from the date of invoice, or as extended by commissioner, as the case may be. If you're not getting the payment within 1 year or as notified or extended by the commissioner, then what will happen is, and it should get in convertible foreign currency, Indian rupees only when it is allowed. If at all it is not received within the time gap of 1 year or as extended by commissioner, you don't get the convertible foreign currency or Indian rupees wherever notified. Normally not Indian rupees, normally it is convertible foreign currency. Then after that period, within 15 days, you have to pay that amount. Then it will not be treated as export. Now what have they amended is, they have said that this 1 year time period is not basically 1 year. 1 year or period allowed under Foreign Exchange Management Act, including extension by RBI. So earlier time limit was you have to get within 1 year or extended by commissioner, whichever is later. Now it is 1 year or time allowed under FEMA, including extension given by RBI, or as may be allowed by commissioner, all the three, whichever is later. So now they have said that it is not only 1 year. Basically it is 1 year, but you refer what is time limit given under FEMA, including any extension given by RBI. So now you have three time limits: basic time limit of 1 year, or refer FEMA if there is any extended time limit, including extension given by RBI or by commissioner. So for export of services, now they're giving relaxation. If an RBI is extended the time limit for another 1 year, so you can get that payment within 2 years. Your convertible foreign currency normally, wherever allowed Indian rupees, but normally it is convertible foreign currency you have to get. If you don't get, it will not be treated as export of services, and after that time limit is over, within 15 days you have to pay the tax with interest, and you will not get any export benefits. You will not at all get any export benefits. So this amendment is effective from 10th of July 2024. So this amendment specifically is dealing with export of services. Make sure that foreign currency, normally at times Indian rupees, is received within this time, 1 year or time as per FEMA, including extension by RBI, or as extended by commissioner, whichever is later. Whichever is not early, whichever is later. Get that payment within that time. If received, not a problem. If not received, it will not be treated as export of services. The moment this time is over, within 15 days, the person has to pay the taxes, output tax with applicable interest. So this is all in all about the amendments of refund. So how we discuss the amendments in refund? The refund is an area where there are lots and lots of amendments, but we made it very simple by discussing refund amendments in 4 parts. One, time pass amendments, which are because of introduction of new return form GSTR 1 in return filing chapter. Other is your rule amendment due to amendment in Rule 96 of Rule 10. Third is amendment due to upward revision in price, which is only for export of goods, because export of services anyways is always manual application. And lastly, other amendments. So this completes our discussion about amendments that in your written filing chapter. Yes friends, now let us discuss the amendments in your appeals and revision. Mainly the amendments in appeals and revision have come from your appellate tribunal. So let us see the amendments which are there in your appeals and revision. The first amendment that we are going to discuss is there in your section 109, which talks about the constitution of the appellate tribunal. As discussed now, the benches of the tribunal are referred to as principal bench, which is at New Delhi, and state benches, which is at various states. So principal bench and state bench. So appellate tribunal will have 2 levels: principal bench located at New Delhi and state benches across the states. Now, what is the amendment which has come? Previously, your appellate tribunal could handle the cases where the cases have come from your appellate authority or revisional authority. So when the cases are coming up from appellate authority or revisional authority, appellate tribunal will take up the cases. Now what has happened is, in your section 109, what has happened is, now your appellate tribunal will take up the orders not only of appellate authority or revisional authority, but also for conducting an examination or adjudication of the cases referred to in section 171 subsection 2, which means anti-profiteering clause cases. So cases where there is an opinion that the assessee did not pass on the benefit of reduction in your output tax or increase in input tax credit, where they took extra profit even after the introduction of GST, where they had the benefit of having more credit or having less rate of tax. So what will happen is, this GST appellate tribunal now will take up the matter of adjudication. It will conduct an examination or adjudicating the cases which are referred to in section 171 subsection 2. So previously, how do you enter your appellate authority? Either there is an order of appellate authority or there is an order of revisional authority. Against these cases, assessee used to go and file the cases there in your appellate tribunal. Now, there is one more case which has opened up. Now, what is that case? If at all you are talking about conducting an examination or adjudicating the matter referred to in your anti-profiteering clause provisions, which is section 171. So here it will not sit as an appellate authority, it will sit as an adjudicating authority, because it will evaluate whether there's actually anti-profiteering or there's no anti-profiteering. So that work will be done by your appellate tribunal. So that's the first amendment. Now, second amendment which has been brought here is, previously, as discussed, appellate tribunal will have principal bench and state bench. Previously, when you talk about your place of supply matters, they were heard only and only by your principal bench. Now, it is provided that even when you're talking about anti-profiteering clause matters where appellate tribunal will sit as an adjudicating body, that also will be discussed or heard only and only by your principal bench. Also, in addition to it, this principal bench can take up any other notified cases which the government notifies on recommendation of GST Council. So, previously, when you talk about your appellate tribunal, this is the second amendment that we are trying to understand. Appellate tribunal will have your principal bench and your state bench. State benches will be across the states. Principal bench at New Delhi. Previously, your appellate tribunal was taking up the matter only and only dealing with place of supply matters. Now, it will take up the matters also of anti-profiteering clause section 171 plus any other notified cases. So, if you want to see the amendments here, first, the scope of appellate tribunal itself is widened. Now, it can take up the matters which are dealing with anti-profiteering clause. Second, in appellate tribunal, you have principal bench and your state bench. Principal bench previously would have taken up the cases only of place of supply. Now, anti-profiteering clause cases and other notified cases will also be heard only and only by principal bench. They cannot be taken up by state bench. So that is the second amendment which has come up. And in your section 109 subsection 6, they have added a term called as subject to the provisions of section 1095, which talks about handling of matters by principal bench and state bench. Now, what is this provision in fact? This provision, section 109 subsection 6, tells that President, by general or special order, distribute the business of appellate tribunal among the benches and transfer the case from one bench to another bench. But this is now subject to section 109 subsection 5, which effectively means that there cannot be any transfer of cases of principal bench cases. So transfer of cases will be there. Only from one state bench to another state bench. Here, you cannot have any transfer of cases. So, because it is being subject to section 109 subsection 5, which tells that there are three matters which will be heard only by your principal bench. Place of supply, which was already there. Anti-profiteering clause, which is newly added. Any other notified case. If at all it is notified under the case where principal bench will discuss the case, any matter which is to be heard only and only by principal bench, it cannot be transferred. Yes, the matters which are handled by state benches, other than these matters, they can be transferred. So that is the amendment which is there in your section 109. And all these amendments, basically there are three amendments effectively. They are all effective from your 1st of October 2020. 2024. Now, corresponding to the new introduction, corresponding to the new workspace of appellate tribunal, where they'll take the matter of anti-profiteering clause acting as adjudicating body. There have been two notifications which are being issued. Actually, it is a continuation of the amendments that we have already discussed. Notification number 18/2024 CT and 19/2024 CT, which is read along with section 171, which is anti-profiteering measures. So it is now very clear that appellate tribunal will also take up the matters for conducting an examination or adjudicating the cases referred in section 171 subsection 2, which means anti-profiteering measures cases. Now the corresponding notifications are released to tell that this is nothing but the corresponding points in exercise of the powers conferred in section 171 1 and 2, read along with section 101(5). Central government has said that principal bench will examine the matters of anti-profiteering measures to check whether ITC availed increase in ITC by a registered person or reduction in tax rate has actually resulted in reduction in the price, which means if at all after introduction of GST there was more ITC for a registered person and less rate of tax for a registered person, they should have reduced the price and the benefit should have gone to the end consumer. Whether this is actually done or not by a registered person will be done by principal bench. That is notified. Again, it is the same thing that we already discussed. That is notified by way of 18/2024 CT, and 19/2024 CT has said that the date before which all the such cases should be referred to principal benches first day of 2025. So it rather has said that central government has appointed 1st April 2025 as a date from which the authority shall not accept any request or examination whether increase in ITC or reduction in tax rate have resulted in reduction in price for the registered person. So it is very categorically clear that now this principal bench will take up the matters of anti-profiteering measures, and all those cases which have to be examined by the principal bench, it has been categorically said that please give all those matters to principal bench on or before 1st April 2025. After that, it will not take up those cases. So it has said that authority will not accept any such request of anti-profiteering measure on or after 1st April 2025. So these notifications were also released on the same date, 1st October 2024, effectively giving 6 months time that principal bench will take up these also matters, and in these 6 months please give those cases to principal bench so that they can do the work. They can do the work after that. There's no deadline for the principal bench to complete the work. It is to hand over the cases to principal bench. 1st of April 2025 is the deadline. So principal bench will take care of the cases dealing with anti-profiteering measure. And it is said that all those cases are principal bench has to look into those cases. Those cases have to be given to principal bench before your 1st April 2025. Thereafter, principal bench will take its own sweet time. So again, that amendment was there in section 101, 109, that along with section 171 and notifications that we have discussed. Now, discussing the other amendments which are there in appellate tribunal, basically the amendments are there in the procedural part now. The earlier discussion that we saw in the amendments was all conceptual. Now we are discussing about the procedural part of the amendments. Now when you talk about appellate tribunal, we have seen that appellate tribunal, who all will go? Either because of the order of appellate authority, you will go to appellate tribunal, or because of the order of revisional authority, you will go to appellate tribunal. And the new introduction is anti-profiteering measure, where appellate tribunal will act as the adjudicating body. So let us not discuss for that for the timing. We are talking about assessee going to appellate tribunal due to appellate authority order, revisional authority order, or department going to appellate tribunal. When assessee is going to appellate tribunal, when assessee is going to appellate tribunal because of the order of appellate authority or revisional authority, the procedure is discussed in rule 110 and it is called as appeals to appellate tribunal. And likewise, when department is going to appellate tribunal, When department is going to appellate tribunal, the procedure for the department when they are going to appellate tribunal is discussed in Rule 111 of CGST rules. So when assessee goes to appellate tribunal, it is 110, Rule 110. When department is going to appellate tribunal, it is Rule 111. And the difference is when assessee is going to appellate tribunal, we call it as appeals to appellate tribunal. We call it as appeals to appellate tribunal. And when department is going to appellate tribunal, we call it as application to appellate tribunal. Technically both are appeals, but the difference in the wordings, appeals to appellate tribunal and your application to appellate tribunal, because we are discussing both of them simultaneously, because both of them are worded in the exact same manner. Both these rules are already there, but now they have been substituted, which means I have not given the old rule, which was that normally the amendments when we see, you'll have the old rules cancelled than the new rules. But here again, old rule is lengthy cancellation. Effectively, they have changed only few things that we'll try to understand. Now, understand there was already a procedure when assessee is going for appeals to appellate tribunal or department is making an application to appellate tribunal. So that was already a procedure. They have made small changes there. Now, firstly, let us understand that when appeals is made to appellate tribunal by the assessee, what will happen? Assessee will make an appeals to appellate tribunal in form GST APL 05. Likewise, when application is made to appellate tribunal by the department, it will be made in a different form GST APL 07. That is 05 by the C and 07 by the department. Other things are all the same. So I'm just highlighting the difference. When assessee goes, it is appeal. When department comes, it is application. Form number is APL 05 for assessee and APL 07 for the department. Now let us see the common points. They have to prima facie file the appeals or application electronically. That is the same there. And whereby there will be a provisional acknowledgement number given to the appellant immediately. So they have to file online. It is only electronically. And they'll get the acknowledgement number, whether it is appeals or application. Appeals by the assessee or application by the department. Now, filing it manually is also allowed if the registrar, if at all the registrar, which includes additional registrar, joint registrar and assistant registrar, by way of special or general order and with the conditions and restrictions, tells that you can file it manually. Basically, when the order is manual, you cannot file your online appeals. You have to file manual appeals, but it can be other cases also. Normally, when do you go for manual appeals? Because if the order is manual, further proceedings will also be your manual thing. But they have not categorically said that. They have said that registrar will decide. Registrar will allow you to file manually by way of general order or special order, subject to conditions and restrictions. And in such case, a provisional acknowledgement number shall be given to the applicant immediately. Right. So basically, they tell that normally we would like you to come electronically. At times, registrar may allow by special or general order that you can come manually. In both the cases, the moment you file an appeals, you will get a provisional acknowledgement number. And this is true for both appeals and application. Now, whenever there is an appeal filed by the assessee or application made by the department, there will be cross appeals, memorandum of cross objections. So what is happening here? There is rule 110 and there is rule 111. Rule 110 is started by assessee, appeals by your assessee, and this is application by your department. All right. Form number obviously is different. Form number here is APL 05 and here it is APL 07. And prima facie they have said that it has to be filed electronically. At times, as an exception they have allowed it has to be filed electronically. As an exception, they have allowed manual appeals where registrar is allowing it, where appeals or application same. But understand that for every appeals by assessee or application by department, there will be cross appeals, which we call it as memorandum of cross objections. Memorandum of cross objections here will be filed by department. Why? As appeal is filed by the assessee, memorandum of cross objections will be filed by the department. In the second case, memorandum of cross objections here will be filed by the assessee. Why? As application is given by the department, memorandum of cross objection will be given by the assessee. And here also they tell the same thing. They exactly tell the same thing. Generally they'll allow generally it will be allowed what? It will be allowed only electronically, APL 6. But registrar may allow by way of special or general order may allow it to be filed manually. So when you talk about memorandum of cross appeals, you will find that memorandum of cross appeals in both the cases, whether it is your by department or by SSC, it is APL 6. So now you have a very clear picture of the forms. If it is appeal by the SSC, it is APL 05. It is application by the department, it is APL 07. In between, it is APL 06, which is cross appeals, memorandum of cross objection, whether by SSC or department, it is APL 06. And the same point, normally electronically, but with the permission of registrar by a general or special order of registrar, you can go with manual thing. This is exactly the same. Now, they tell that all these things will be authenticated. Anything that you file, whether you file appeal or application or cross appeals, it is all authenticated in a manner under Rule 26, which means either it is your one-time password or electronic verification code or e-signature. So that is given, same thing that is given in 111. So I'm not taking those cases which is same in 111. All these things are exactly same in 111. Now they talk something very important. What is the date of filing of appeal? Because you have to file appeals within particular time. So what will be taken as date of final appeal? If at all, there's a situation where the order that you have appealed against is there on common portal, which means electronically, you'll get a final acknowledgement number with the appeal number. So finally, you'll get a final acknowledgement number with the appeal number. It will be there given in APL 02. And in such cases, date of giving provisional acknowledgement will be treated as date of filing of appeal. So if at all the order against which you have gone and filed an appeal is an electronic order, it is there on the common portal and you have filed electronic. So there is an electronic order, you have filed electronic appeals, you got provisional acknowledgement number, then you get final acknowledgement number along with the appeals number in APL 02. Right, when you get that, the date of issuance of provisional acknowledgement will be taken as date of final appeals. You might get final acknowledgement number later, but date of filing of appeals will be provisional acknowledgement. So you need not worry. But in cases where the order you are appealing against is not there on the common portal, which means order is manual order and you have filed appeals also manually by taking the order from registrar, then the appellant shall require to submit or upload the self-certified copy of the order within 7 days of filing APL 05, which means within 7 days when you file it, you will be getting, you have to upload rather. You have got manual order, you have filed manual appeals after the order of registrar. Now you got provisional acknowledgement number immediately. Within 7 days, you submit a self-certified copy of the order. The moment you do that, you will get a final acknowledgement with appeal numbers in APL 02. And in such cases, again, the date of provisional acknowledgement will be taken as date of filing of appeals. So that will be very much there. So whenever you get an appeal number, it will be APL 02. Now, if at all, it is a manual order that you have got and you got the provisional acknowledgement number. So you got a manual order. You took the order from registrar and filed the manual appeals. You got the provisional acknowledgement number, but you did not upload the self-certified copy of the order for which against which you're filing an appeals within 7 days. Then you'll get a final acknowledgement number along with your appeal number in same form APL 02. But in such case, the date when you have submitted or uploaded the self-certified copy will be taken as date of filing of appeals. Now, please understand the same thing, exactly ditto, word by word, you will find same here, word by word, exactly ditto, same here. So I'm not highlighting anything there. Now what are they trying to tell? They are now trying to tell that see whether your order was an electronic order, that is on online. Electronic order means it is there on common portal, or whether your order was manual, which was not on portal. And normally for electronic orders, you will file online appeals, and for manual orders, normally you will file manual appeals after getting the order from registrar. Now, if it is that particular scenario, they tell that finally you will get a, in any cases, finally after you give the self-certified copy, if it is an electronic order, automatically you will get the final acknowledgement number with the appeals number. And importantly, they tell that here your date of filing of appeals will be equal to date when you got the provisional acknowledgement. Right from the beginning, the moment you filed your appeals initially, you got the provisional acknowledgement. You got the provisional acknowledgement. So when you have filed your APL 05 or APL 07, you got the provisional acknowledgement. So you would have got your provisional acknowledgement immediately when you have filed your APL 05 or APL 07. This is applicable, whatever we are discussing is there in both. But if at all the order that you have got is a manual order and the appeals that you're going to file is your manual appeals after taking the order from the registrar, then you have to take care of two things. You have to ask yourself, did you upload or submit the self-certified copy of order on the common portal within 7 days? If yes, again, please understand the moment you do that, you will get final acknowledgement number with appeals number. And whenever you're talking about final acknowledgement number with your appeals number, it is always in APL 02. Appeal number, you'll get that. Right. And in such a case, your date of filing of appeal is again when you have originally given the appeals or application, the date of your provisional acknowledgement. The date of your provisional acknowledgement. So here also you're talking about date of provisional. Initially, when you have filed your appeals. So date of filing of appeals will be a date of provisional acknowledgement. Now the issue comes when you got a manual order and against which you're going for manual appeals after taking the order from the registrar, and you do not upload or submit the self-certified copy of order on the common portal within 7 days. You don't do this work within 7 days. Whether you do within 7 days or you do after 7 days, one thing is sure, you will get a final acknowledgement number and appeals number. And final acknowledgement number and appeals number is nothing but APL 02. But here what will change is your date of filing of appeal will be taken as date when you have uploaded or submitted the self-certified copy. A date when you have uploaded or submitted the self-certified copy. To make you understand things in a very simple way. If at all it is an electronic order, you have filed online appeals. The moment you file the appeals or the moment you file the application, you will get something called as provisional acknowledgement. And thereafter you will get a final acknowledgement. And in such a case, final acknowledgement with appeals number in APL 02. It might take some time, after a week, after 10 days, after 15 days. But date of filing of appeals when you got the provisional acknowledgement, the old date. But in the cases where you have got manual order, you have filed manual appeals, and after you file manual appeals, you have got the provisional acknowledgement number also. But there are two scenarios possible. You uploaded the self-certified copy, your own certification, no need of any other certificate, self-certified copy of order within 7 days. Again, you will get a final acknowledgement number with the appeals number in APL 02. But in this case, again, date of filing of appeals would be date when you got the provisional acknowledgement. So you filed appeals, you got provisional acknowledgement. Within 7 days, submit the self-certificate copy of your order electronically, and your date of filing of appeals would be the initial date, old date. But if you do not upload or submit the self-certified copy of order on common portal within 7 days, still, whether you submit within 7 days or not, you'll get a final acknowledgement number and appeals number in APL 02. But in this case, the date of filing of appeal will not be old date, it will be the date when you actually uploaded the self-certified copy of the order. That is the intent. Actually, it was the same earlier. Now they have just given with a clear-cut wordings. And it has been categorically said both in Rule 110 and 1110, very categorically said that only and only after you get final acknowledgement number with appeals number, it will be treated like appeals is filed. So till you get a final acknowledgement number with appeals number in APL 02, don't think that your appeals is filed. You have to get final acknowledgement number with appeals number, only then your appeals is filed. Now, the second difference that you'll find here. The first difference is the terms appeals by assessee, application by department, APL 05, APL 07. The second difference is the fees. When application is made by the department, there's no fees, but when appeals is filed by the assessee, there is a fees, and that appeals fees is ₹1000 for every 1 lakh of tax or ITC involved, or difference in tax or ITC involved, or the amount of fine, fee or penalty. If at all, it is only fine, fee or penalty. But it cannot be exceeding 25,000 rupees CGST, and it cannot be less than 5,000 CGST. So they have kept minimum appeal fees is 5,000, maximum appeal fees is 25,000. Earlier, minimum appeal fees was not that, maximum appeal fees was that. Now it is minimum 5,000, maximum 25,000. Also, they have said there could be a case where it is not dealing with any tax, interest, penalty, fine, or etc. It is supposing there's a criminal proceedings. It has got nothing to do with tax, interest, fine, penalty, etc., etc. Then the appeals fees is 5,000. So appeal fees, there are two changes. First change is they have brought a minimum appeal fees of CGST 5,000, same copy paste SGST 5,000. Maximum CGST 25, SGST 25. So minimum was not there. For every 1 lakh rupees, appeal fees is 1,000. Supposing it is 49 lakh rupees, 50,000. So for every 1 lakh rupees, it is 1,000. So 49 lakhs means 49 multiplied by 1,000. 49 lakh 50,000 means 50 multiplied by 1,000, 50,000. So it goes in this way. For every 1 lakh rupee, it is 1,000. But minimum is now 5,000 CGST appeal fees. Maximum is 25,000. So minimum was not there earlier. Secondly, there could be a case where you're going to appeal a tribunal, but it does not involve any tax, interest, late fees, fine, penalty. In that case, appeal fees is 5,000. And they have again said that there's no appeal, no fees when it is all about rectification of errors. You will not find any provision. You will not find any provision for fees. So if you see, what is the amendment brought here? Application by department is very similar to appeals by assessee, except for fees aspect. Now earlier, when you talk about application by department, it was very short and crisp. Now they have given a detailed provision with effect from 10th of July 2024. Even your appeals by SSC to appeal tribunal 10th of July 2024, all the amendments effective from. What are the changes brought out in the provision? Basically, the provisions were the same. What are the changes brought? The changes brought here is more clarity is given on the procedure as to when it is manual appeals and when it is electronic appeals. And there is minimum appeal fees which is fixed as 5,000. So that was not there earlier. These are the amendments here. Right. So basically here, if you want to complete it and see the differences here, please understand, for memorandum of cross appeals, there is no fees. For application by department, there is no fees. For appeals by SC, yes, there is a fees. Now minimum 5,000 to maximum 25,000. And how is the fees is determined? For every 1,000 rupees of the case involved. For every 1 lakh rupees of the case involved, it is 1,000 rupees. So if it is 49 lakh 50,000, it means it is 49.5. It is taken as rounding off, not rounding off, next number, 50 into 1,000 rupees. For every 1 lakh, 1,000 rupees fees. If it is 2 lakhs, 2,000. If it is 3 lakhs, 3,000. But minimum is 5,000, maximum is 25,000. Where the cases does not involve any tax, interest, fine, late fees, penalty, then the fees is 5,000. All these fees are only of CGST. Same would be for SGST. So that is the amendment brought out in your Rule 110, Rule 111. Basically, Rule 110, there is more clarity as to when it is manual appeals and when it is electronic appeals, and minimum appeal fees is fixed. And Rule 111, there's a detailed provision. Earlier provision was very crisp, small. Now there is a detailed provision for application, very similar to that of appeals, except for the fees matter. Earlier it was only very swift that they have to file APL 07. Now it is a very detailed thing, which is exactly worded like your Rule 110, and there's only one slight change. It is application by department. Second, fees is not there. And they have also clarified that for both Rule 110 and 111, registrar would also include joint registrar, deputy registrar, and assistant registrar. Now, the last amendment in your appeals and revision chapter, again dealing with your appellate tribunal, they have introduced something called as withdrawal of appeals or application. So this withdrawal of appeals or application is Rule 113A. Please understand the background. When you are making the first appeals, it is to appellate authority. Withdrawal of appeals from appellate authority was earlier allowed. Now also they have introduced withdrawals of appeals application from appellate tribunal. So we have filed an appeals. Now you feel that no, I need not go with my appeals. Can I withdraw my appeals? Yes, you can withdraw your appeals. You can very much withdraw your appeals. Earlier, withdrawal of appeals is allowed only at the first level, appellate authority. Now withdrawal of appeals is allowed even at the second level, appellate tribunal, by way of introduction of Rule 113A, which is also effective from the same date. All these three rules, 110 fully substituted, 111 fully substituted, and 113A new rule, they're all effective from 10th of July 2024. Exactly similar wordings is there for withdrawal of appeals or application in appellate authority. Now it is appellate tribunal. Now whosoever is the appellant, whether it is the assessee or the department, before the issuance of order in respect of any appeals, whether it is filed by the assessee APL 05 or application by the department APL 07, may withdraw the appeals, APL 05 withdrawal or APL 07 withdrawal. But they said that after getting final acknowledgement with appeal number in APL 02, withdrawal can happen. Generally, they tell that first you can withdraw. If you have filed an appeal or application, you can withdraw. First, they give the provision. But they tell that if at all you have filed an appeal, first you will get provision acknowledgement, later you will get final acknowledgement number with your appeal number APL 02. If you have got your appeal number, then withdrawal still is possible, but with the approval of appellate tribunal. So you have to convince, you have to take the approval of appellate tribunal, and that appellate tribunal will decide. So if you are making an application to appellate tribunal for withdrawing your appeals, that matter for withdrawal will be decided within 15 days. The only difference that you can see is this 15 days is 7 days when it is about withdrawal of appeals by the first authority, appellate authority. So here they are giving appellate tribunal is a higher level, so they are giving some more time, 15 days. So basically what they tell, if you filed an appeals or application to appellate tribunal, can you withdraw? Yes, you can withdraw. But if you have gotten final acknowledgement number with your appeals number in APL 02, you can still withdraw it. Get the approval of your appellate tribunal, and for your application for withdrawal, when you have to tell that I have to withdraw my appeals application. Appellate tribunal will give an order, will decide whether you can withdraw or not, and that decision will be taken within 15 days after you make a request for withdrawal of appeals or application. Now, understand that after withdrawal, you may feel like, no, I should not have withdrawn. My appeal should have been very much intact. So can you refile the appeals? First it is withdrawal. Can you refile it? Yes. After withdrawal, if you feel that no, I should have filed my appeals again, I should have, in the first appeals, I've done something mistake. Now I'll file fresh appeal application. I can file it, but subject to the time limit does not change. The overall time limit for filing your appeals to appellate tribunal should not have elapsed. Within the time limit allowed to file an appeals to appellate tribunal, within the time limit allowed, you first file the appeals, withdraw it, and again file fresh appeals. But it should be overall within the time limit. Time limit did not extend. So can you withdraw your appeals? Yes. If at all your appeals number, final acknowledgement number is already given, can you still withdraw? Yes. But in that case, it will not be automatic. You have to, if at all it is before final acknowledgement number with appeals number, you can withdraw just like that. If it is after final acknowledgement number and appeals number, please get the approval from appellate tribunal. And when you make that application for withdrawal, appellate tribunal will decide within 15 days. After withdrawing, can you file fresh appeals or application? Yes, but it should be within the time limit frame. Time frame is different for assessing, different for department, but it should be within the original time frame. There's no extension. So that is given for your appellate tribunal. This was already there for appellate authority first level. Now it is introduced for the second level. Withdrawal of appeals was already there for appellate authority. Now it is introduced for appellate tribunal. The only difference that you could find here or sense here is that time limit here, it is 15 days for appellate tribunal to decide whether withdrawal should be taken or withdrawal should be allowed or not in case appeals number is given. For appellate authority, it is 7 days. So that is the only change that you could find. Yes, friends, now let us discuss amendments in your offenses and penalties. We have a new section introduced, which is section 122 capital A, which is there for a manufacturer of notified goods where he is failing to register his machineries used in manufacturing of notified goods. One of the notified goods that is pan masala. Now understand that whenever you talk about all these notified goods, specifically say for example pan masala, depending on the machineries, there will be the output, type of machinery, the size of machinery, etc. That will be the output. And a lot of times these cases, if they don't show the machineries, the production will be a different quantity, and what they are actually showing in books will be a different quantity. So to make sure that the tax evasion in such cases, which is huge, is minimized, they have introduced registration of machineries by manufacturer of notified goods. When they have introduced this particular provision that manufacturer of notified goods, say for example pan masala, have to register their machineries, they knew that even after telling that it would be a challenge for them to get registered. So they have introduced a new penalty provision. Now what this penalty provision tells, it is a very dangerous provision, by the way. If you see the language, it tells that notwithstanding anything contained in this act, where any person who's engaged in manufacture of the notified goods and to whom special procedure with respect to registration of machineries has been notified under section 148, and if he is not doing so, the moment he is not doing so, in addition to any penalty that is going to pay in chapter 15, that is demand and recovery chapter, and this chapter, that is offences and penalty chapter, he may be liable to penalty under demand and recovery chapter, he may be liable to penalty under the same chapter, offences and penalties, but he'll also pay an extra penalty, which is 1 lakh for every such machine which is not being registered by him. So he may be liable to penalty under section 73, 74 or any other provisions of this chapter in section 122 series. In addition to that, he has to pay a penalty equal to 1 lakh for every machine. So if he has got 10 machines and he has registered only 6 machines, for the balance 4 machines, for each of the 4 machines, 1 lakh. So 4 lakh rupees penalty he has to pay. And not only that, in addition to paying the penalty, the machines which are not registered, they are liable for seizure and confiscation. So not only penalty will be there. So there will be penalty. 10 machines are there, only 6 are registered, 4 machines means 4 lakhs penalty will be there. In addition to it, that machine itself will be taken for seizure and confiscation. But if you want to avoid this confiscation, you can do so by paying this penalty, which is, in our example, it is 4 lakhs, and registering all such machines which are not yet registered within 3 days of the penalty order. So it is very, very dangerous. What it is telling? We have asked manufacturer of notified goods to register all their machineries. If you have not done, you may be liable for penalty under demand and recovery chapter under this chapter, plus extra penalty under 122 capital A will be there. which is 1 lakh for every machine which is not registered. If 4 machines are not registered, 4 lakh rupees will be there. Not only that, there will be seizure and confiscation of those 4 machines. But if you want to avoid this confiscation, pay this penalty and get all those 4 machines registered within 3 days of the penalty. Do it soon now. Still, penalty will be there. 4 lakhs you have to pay. You can escape confiscation. This is effective from your 1st of October 2024. So that is the amendment which is there in your offences and penalty chapter. And miscellaneous provision. In miscellaneous provision, one provision is at a time pass, where you're talking about consent based sharing of information, rule 163, where they had the reference of GSTR1. We have already discussed that because in your written filing chapter there is an introduction of GSTR1A. Wherever throughout the act or rules you find GSTR1, it will be GSTR1 as amended by GSTR1A. So throughout. So that is not so consequential, and this entire written filing chapter has underwent change with the concept of GSTR1A with effect from 10th of July 2024. So the same thing holds good. So that is not an important amendment. Now what is the other amendment which is there? Rather, you're talking about the same consent based sharing of information which is given by a taxable person. Section 158 capital A. So after getting consent from you, GST portal, common portal will share information to other people. Now, central government has notified public tech platform for frictionless credit. A new platform, public tech platform for frictionless credit, which is under control of RBI, as a subsidiary of RBI, along with accounts aggregator. Accounts aggregator was already there as a systems with which information will be shared by the common portal, but after taking your consent. So your data, your information, taxable person information which is there available on common portal will be earlier shared to accounts aggregator. Now it will be also shared to whom? Public tech platform for frictionless credit. Now you may wonder, what is this public tech platform for frictionless credit? It is nothing but a system with which information will be shared by common portal under 115A. The meaning of that is it is an enterprise grade open architecture information technology platform which was conceptualized by RBI as it's one of the policy which is statement on development and regulatory policy to control all the information. More and more information, more will be tightening of all the policy procedures. This platform, public tech platform for frictionless credit, was developed by its subsidiary. RBI has a subsidiary called as Reserve Bank Innovation Hub. So this public tech platform for frictionless credit was made by Reserve Bank Innovation Hub for the operations of large ecosystem of credit to make sure that there is an access of information from various data sources digitally, where the financial service providers, who will share the data? Financial service providers and multiple data service providers. So one is financial service providers, they'll get the data from financial service providers, say for example Muthoot FinCorp, they'll get those data, information from financial service providers. Also multiple data service providers converge on a platform, they will share the information. How? Using standard and protocol driven architecture, because if the architecture is designed in such a way that the incoming and outgoing of data can be very easy, so that platforms will be converted in such a way that sharing of information is very easier using standard and protocol driven architecture, open and shared API, application programming interface framework. So the introduction of public tech platforms for frictionless credit, more and more information is with RBI. Say for example, I'll give you with an example. Supposing you are supplying to a person, or you yourself are registered on GST portal, and you're not filing your returns properly, you're not paying your taxes properly. If that data is being shared from the common portal to public tech platform for frictionless credit, they may further intimate the banks, because it is under RBI subsidiary Reserve Bank Innovation Hub. They may share that information to banks, and banks will have more transparency. When the same person who's not filing returns and paying taxes properly is making an application for loan, so this data is there with whom? RBI subsidiary Reserve Bank Innovation Hub. in which platform, in which app, this public tech platform for frictionless credit. This information further will be shared to the banks. And what will happen? Your credit scoring will be again impacted. One of the factors to decide your credit scoring would be this. So the banks would be informed that this person is not paying taxes properly, filing his returns properly. So that might be a reason why the loan may be rejected, or the assessee is making application for loan is telling that his turnover is 100 crores, whereas in GST return, which is available with common portal and which is shared to public tech platform for frictionless credit, it shows that it is only 10 crores. So assessee has said that no, my turnover is 100 crores, but the common portal, the GST portal, is sharing the information to public tech platform for frictionless credit under the control of RBI, which is further sharing the information to the banks and financial institutions, telling that this assessee's turnover is not 100 crores, it is only 10 crores. It can only share the information. Then action is to be taken by the banks. That will make sure that systems are more in place. So that is the objective of this particular provision. So this is effective from 22nd Feb of 2024. So all these amendments we have discussed, which are applicable for your exams.